week-to-week buys and sells from institutional money. The Edge Finder also has a retail positioning tool, which allows you to see what the crowd is thinking about your favorite charts, symbols, both currencies, commodities, and indices. You can also check out the latest seasonal trends, month to month, week of the year, and much more to spot potential opportunities coming up in the future. The Edge Finder also makes economic data much more easy to read, like our GDP charts, our retail sales numbers, PMI data. We can also check out the jobs data, unemployment claims, and so much more. At the touch of a button, you can check out the latest reports from the economic data that moves the markets. Right now in the live stream chat, we'll be dropping a link where you can speak directly to a team member about getting yourself set up with a copy of the Edge Finder today, and we'll give you a nice live stream discount. Click that link and chat with the rep to find out what kind of discounts are going on right now. Now back to the stream.
Hey everybody, happy Monday. How we doing? Just getting a trade in on the IWM. I'll share that with you in just a moment. I have 2 more accounts to fill, so let me get this trade in. And last one, I'll share the mechanics of the trade here in just one moment. How's everybody doing? Hope you all had a good weekend. Last week was a pretty crazy week. I think that's pretty safe to say. All right, so IWM, we'll talk about that in a moment. I'll go through all the charts that I'm interested in. Just had a chart alarm go off on Ford. We're trading at 14.39. I want to take a look at that also. I own shares around like $9. I've owned it here in this little consolidation between $12 and $11. Use options pretty actively to lower the cost basis. So I'm okay kind of letting the price go. But if we came back up and to fill some of this supply zone around, you know, $14.75, $14.80, $15 to me would be a nice kind of target to go after. I'm not trying to hold on to Ford to, you know, $25, $26. I'm good literally flipping it for maybe $3-4 bucks. Let's go to IWM. And we're trading at 215.74. So the trade that I just took on the IWM, and I'm going to jump into my spreadsheet here as well. And I also want to center a trade on the SPX today. So SPX around 56.40. We gapped from 56.15. I'll go ahead and center it here around like 56.30, 30. Okay, 56.30. Let me get a trade on this one. So 56.30. It's going to be a 0 DTE. 56.30. If I center it there, I'm just looking at deltas. So if I did like a 12, I'm going to go out a little bit further. So a 12 delta, it's on the low side. It's 10 a.m. So 56.70 down here at 12 delta, 5600. I know it's typically I like to go, you know, maybe 15 or 16 delta, but I'm going to try to stay out of the way, get this trade in profit, 355 credit. But if I spread it, let's go 20 points here and 20 points here. So 250 on the credit. So that'll be tracking for today. 7/12 was Friday. And 7/15 is today. I'm centering around 56.30, which means I'm selling the 5600 by 56.70. Okay, that's for $2.50 credit. If I take the trade, 2.50 times 1.5, I'm looking at about a $40 profit. So 210 is going to be my debit on the day, and go after 40 bucks. I did take, so far doing this type of trade, the win-loss record, I've had 3 losses and 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 wins. So 16 winners, 3 losses. Let's do the math on that. So 16 out of 19. Right now, hitting about 84% strikes of wins. I need, you know, 250 or 245 credit to give me about $30 to $40 of profit. Just a little daily income there on the SPX. IWM, let's go back to that for a moment. IWM is up here at 216. So what I just did, I'm going to actually go back to the SPX on this chart and then go over to the IWM here at 216. So what I've positioned for on the IWM, and I have quite a few positions running here. So I'll show you, here's IWM right now. If you can see my numbers. So IWM currently is up around $4 grand on the day, around $8,600 in the portfolio. And this move is just getting started. I've been positioning for this kind of out of the way, you know, out of the money credit spreads, bull put spreads, some leaps on IWM to stay above certain levels or rally. And so I'm getting a little bit more directional now. And so the trades I just filled for everybody is the following. I'm going out to February of 2025, and I'm putting on basically a combo debit spread. So what I'm doing is this. I am buying the 240 and 245 call. Okay, so the 240 and 245 call, and then against that, I'm selling the 270. So I'm willing to kind of cap my upside here, but 270 is all the way up here towards, that's a 25% rip on this instrument. And I know we could get there, but I think realistically for me, I would just be happy to see if price is going to get to these all-time highs. That's what I'm positioning for. So I'm out of the money. This debit spread is not that expensive. I only paid about $7.45 for it. And I'm giving myself $25 and $30 of credit potential. So here is a February 2025 expiration. I have the 240 long call. I have the 245 long call. And it's against that, I'm selling a 270 sell call. So the other way to look at this would be it's a 240 by 270 bull call spread and a 245 by 270 bull call spread. That makes sense? So my net debit, $7.50 debit. And then I have $25 to $30 max credit on the trade. So right there. So what I'm looking at is, will the IWM be the catch-up trade that I think it's capable of doing? I looked at this when we had that rip in Q4 of 2023 into this year. The Russell was only up about 1%. Okay, now it is up like 6 or 7%. It is coming back in a pretty big way. And all I'm looking at is it's been here. If we are going to see the Russell or the small caps catch up and try to hit all-time highs, that brings, you know, I mean, broadly, we could see this, the S&P higher, we can see the NASDAQ higher. But if this is the, you know, trade that was up 1% for the year, this is the trade that was up 4% for the year, this was up 18%, this is up 25%. There's that catch-up potential on IWM small cap that I'm trying to take advantage of. So I like the positioning for it. My profit's going to be around 10 grand if I'm right, only about $1,400 if I'm wrong. I think that's a pretty good upside potential to take away. Okay, so that's my plan, IWM. I'm going to actually post this in my trading room right now. I don't have a live session for Equities on Demand students today. And James, on your end, I do have to bounce. And I know I never say this because I'll just stay until you guys pull me off. But today I do have to leave at the top of the hour. So if you have another guest coming on at 11 a.m. Eastern time, great. I'll wrap up my session right around then. So, okay, let's have a look here. I'm going to jump into my Telegram channel. I'm going to post this trade. So 240 by 270, 245 by 270. I paid $7.50 on the debit. So right here, new trade, IWM, and it's a February 21st. So February 21st, 2025 expiration, buy 240 call, sell the 270 call, and then buy the 245 call, sell the 270 call. It's a combo debit spread. It's a bull call spread, 750 debit, 25 and 30 max credit. The play is for small caps to catch up to large cap and hopefully outperform and allow the IWM Russell 2000 to revisit all-time highs. Okay. So that's a trade from Equities on Demand trading room. All right, that's IWM. Everything else is looking pretty decent. I've got my way out of gold, so I'm still long on gold. I'm just going to go through. So my Pulver report here, I built this watch list. This is a really easy way for me to kind of get top-down analysis. Things I'm watching this week. Okay. Last week was really crazy. I just finished a live session, so I'll repeat some of that stuff. But I hope you paid attention to last week and kind of what matters in the short term over the next couple of weeks. We hit five all-time highs last week in the S&P. That's insane. Monday was a brief, barely carved out an all-time high. Tuesday, barely carved an all-time high. Wednesday was a directional day, carved out an all-time high. Thursday, gapped higher on CPI, faded hard, but still technically hit an all-time high. And Friday's recovery trade hit an all-time high. That is a lot of crazy stuff going on here. And does it mean that there's more to come? Maybe. Okay. I still stand by the outlook of, I think we're overextended. I think a correction is needed. We are now through an interesting phase of data. We've gone through some U.S. news where the market's expecting a rate cut. Okay. In fact, I did see something that was changing quite a bit. The Fed Watch tool has changed to now a probability of a rate cut in September, in November, as well as December. Okay. So let's take a look at that CME Watch tool for a moment. We're sitting here near all-time highs. My little red line that's attached to price, those are all overextended conditions. I see a lot of divergence on daily and weekly timeframes. I see overbought conditions on the relative strength. Again, I see them. It doesn't mean that we're going lower. The last couple weeks especially, what am I doing? Well, I am trying to trade some positions where this up here is a broken wing butterfly where it's all calls. So if price goes higher, I have this thing trapped for profit. Okay, so I have credit here. I have my 10x trap right here, and then I have my risk. I'm giving myself the ability to let this price for the next couple weeks out to the 26th or out to the first week of August. Hopefully, if we're going to drift higher, I'm trapping some profit there, and I can maybe turn what should be a high probability credit into possibly like an 8 or 10x return. On the downside, if we have something that turns the market south, I'm very hedged to the downside to make sure that I don't give up any of these gains I've had this year. I'm just playing defense. I'm not turning bearish. I am not bearish. In fact, I think if anything from last week to over the weekend's events, I think the market has turned maybe slightly more bullish because the decision for maybe who's going to be president, what administration comes in, is probably looking more of a probability. I think the Trump polls were showing a favor of like 59% probability of him getting the presidential vote, and now it's up to like 71%. So if that's the case and it's a Republican sweep with Senate, House, I mean, this could be great for equities. It could be bad for bonds. It just depends on how the fiscal policy plays out. I don't think the Republican Party is going to be showing austerity measures. I think they're going to spend just like they were spending back in 2016 to 2020. My biggest concern would be deglobalization with a Republican sweep. And on top of that, probably, social reform would probably be an issue with Republican sweep as well. But, I don't trade politics. Okay. I trade policy, but we could see some interesting developments there. But if the market likes a certainty or higher probability, we might see the markets moving in a favorable way. So all-time highs, are we just going to continue to stretch and never pull back? I don't know. I think technically we're due for one. We clearly saw the markets were willing to jump. Like Thursday last week did show a potential rotation that was like sitting under the surface. And last week, Thursday, was the opportunity for the market to then start to do it. Apple's made a big run. We're at 3.6, 3.7 trillion on Apple. Now it's way ahead of Microsoft, way ahead of Nvidia in a big way. And so now you're stacked up 1, 2, and 3, Apple, Microsoft, Nvidia for your 1, 2, 3 market caps. This week in earnings, Netflix is one that I believe that's still a top 10 in the S&P. We have some consumer ones with United Airlines, some American Express. We have some home builders with D.R. Horton. We have some material plays. Alcoa has earnings this week. So there's 116 stocks reporting earnings this week, which is not nothing. We were in the 10s and 20s and very little the last couple of weeks as earnings season wound down, or was winding down rather. It sounds better. And here we are, 116 just to kick things off. So we had some financials last Friday. We have Goldman Sachs, we have Bank of America, Morgan Stanley, Charles Schwab this week to kick things off Monday and Tuesday, and then get into kind of the meat for more earnings. So I do want to look at an earnings play on Netflix. Let me see if I can price this out with you. Options Slam. And let me get logged in here. Nope, it just freaking pulled up the website. You sneaky turds. All right, so get logged in here. All right. So here's what I'll do. I'm gonna log into Option Slam. I'm gonna take a look at Netflix, but I'm going to go through my kind of top-down weather report for everybody. Just give me 1 second. Slam. There we go. Okay, so I'm in and Netflix. All right, so here is what I'm looking at. Google purchased company in Israel for $23 billion, WIZ. Yep, I saw that this morning. All right, Netflix. So the nice thing here is we do have some good volatility around Netflix. You can see some big prints. The average print is around 12.88%. That'd be my expected move. Let me take a look and see what Tasty has measured here for the IV rank. So IV is at 80.2, which is pretty solid. If I go to trade here, we're expecting a move of about, let me go to maybe next Friday on Netflix. So they're looking for about a $60 move over the next 2 weeks. Right. So this is an IV rank of 80.2. The IVX is 69.3%. About a $60 move. Now, I'm going to calculate it kind of my way. I know the ATRs have been pretty solid, but with earnings, there's always chances for big jumps. If we go into Netflix right here, trading around 662, we open the day up around 646. It's already up $16 for the week. The weekly average is $37.20 on Netflix. Okay, so Tasty's platform with expected moves around $60. I'm going to calculate it out with my earnings here. Now the last, I'm going to go 1, 2, 3, 4, 5, 6, 7, 8, 9 earnings. I see that we've had some around the 10%. So 9.4 to 9.92. That's sub 10%. We had a 10.46, 11.8. I'd say to be somewhat safe on this trade, I'm going to calculate out what's a 10% move to an 11% move. So if we did 10% and the stock's trading for 662 right now, 662.86, we're looking for about a $66 move conservatively. If we hit 11%, so $66 is pretty safe. $72 is up there. And then if we hit the actual average at 12.88, I'll go 12.5 to be, again, just a little conservative at 662. So anywhere between like $66 and $82 on Netflix. So about $66 to $82 expected move. Okay. So what I'm going to do for my trade is I'm looking to see if I go out to next Friday, and I'll price this out 2 ways. If I went out to this Friday, the 19th, which is right after earnings, Netflix earnings is Thursday after market. So I'd only have Friday to manage this trade. All right. I'm going to go out a little bit farther just to be on the safe side, because if we have we don't have a big immediate reaction, then I don't love the trade. But if we do have an immediate reaction, at least I have some time in my side. In addition to, if we have a lull or a lack of movement, maybe we have some more follow through going into next week. So if I go out to the 26th, which is next Friday, I'm going to try to sell like $60 in the money on some of these credit spreads. All right, so we're trading at 663. I'm just going to say 720. Okay, 720. If I do an in the money bull put spread right there, the bull put spread for a it's a $5 spread, I could collect about $3.50. That's not too bad. Okay, 3.50 minus 5 or divided by 5, I can collect about 70% of that max spread in credit. So I like that trade. Okay, here I'll do another $60. I'm going to take this down to $600 and do a bear call spread. There. So for this trade, I'm only risking about $2.40 or so. I'm going to try to get 750 on the fill. Okay, 750 on the fill. Earnings wise, if I'm looking at their, I'll take 2 contracts here. I'm going to try to get 750. And the goal is this: if I can collect 750 up front and the trade hits an expected move, then this 750 credit will probably quickly turn into like a 650 debit or a $6 debit. And I'm looking just to take a little bit off the top. I'm not trying to make the full 750 credit, or in the event of one losing and one winning, taking a 350 credit net. So the result is this, okay? If I have, let's say $3.50 credit, okay, on the winning side, that means I'm risking about $1.50, all right? So if I have one winner and one loser, where my winning side, I make $3.50, my losing side, I lose $1.50. If I have $3.50 as my winner and $1.50 as my loser, I still walk away with $2 credit. Yes or no? Right? Now that's if I go all the way to max profit. Now what I really need to see here is if I do this as a trade as a whole with all 4 legs, as long as I see a 750 credit that is trading for less than that, I'm in profit. So if I see this trading for, what is happening with this price? That credit is way higher now. That can't be. There's no way I'm gonna get filled on a 750. 750 is reasonable. 914, there's no way. This spread is getting pretty wide. So let me see if I can get 750. I guess I'll try, something ridiculous like $8, but let me find out. So if I did the 720 by 715, 720 by 715, and the 600 by 605, no, I'm just gonna. I think it's not fudge. It looks like 750 might not be filled right now. So let me try 750. Hopefully, I'll get filled. That was easy. All right, 750 got filled. That's good. All right, let me fill these up for my accounts here. There we go. And next. Okay, a couple more accounts to fill up. And last one. There we go. So that's a 715. So I'll do all this. I'm going a 720 by 715 and a 600 by 605. So this is a 726 expiration. Netflix earnings play. And I got filled for $7.50 credit. So my goal on this trade is if I can take that 750 credit and let it deteriorate and decay to maybe $1, $1.50 net profit. That's really it. So if we have a ridiculous move on Netflix, awesome. If we have an as expected move on Netflix, that's fine too. I don't have a lot of risk on the trade. So basically I'm risking $2.50 to make a net. Well, I should say, look at each individual trade. I'm risking $1.50 to make $3.50 or more. Actually, I'm making $3.75. So that's not a bad way to play it. I've got plenty of buffer on the profit side to make net profit. Okay, Cedric says it looks complicated it's not. It's not. I mean, I promise you this. If you come into these live sessions and you spend some time with me, you'll see me do the same thing over and over again. We have some teaching moments. I'll break down the trade. All this is trading options. So here's another way to trade it. Okay. The other way to trade it is if you want to spend a lot more money, I'll show you how to trade it that way. So if I go into Netflix and I say, okay, I'm going to buy a call on Netflix. You know, the earnings is Thursday after market. I'm just going to buy a call. Well, if I bought a call right now on Netflix expecting earnings to be great, a call option at the money is going to cost me $28.75. Now, here's a good thing. If the expected move is $60 and it's $60 to the upside, if we get a $60 move on Netflix by Friday, when it opens up, I can take a $29 debit and turn it into a $60 credit, which is great. The problem is if it goes to the downside, I'm going to lose on that trade. Okay. So if I want to do, okay, I'll trade it both ways. Well, now if I trade it both ways, you expect to see about a $60 move, and now I'm going to have to pay $57 to trade both sides. So it's more expensive. There's more risk on the table. And I just don't love, putting all of this risk right up front on a, 1-day management. Because if I did this out to the 19th, that's all I have to manage this trade. So that's not the route that I'm going to go. Okay. If I do it a way that I like to do it as well, which would be I go one strike out, and I'm long in that capacity. And then I sell against it around the expected move. So 665, I'm going to go up, let's say I go up, $80, and I'm going out farther. I know I could sell the $60. Let's just figure it out. So if I sold $60 against that, 665 to 725, okay, and then 660 down to 600. Oops, that needs to be a sell there. So I can take what's expected to be about a $66 to $82 move. I'm giving myself, there's no way that's right. That's not right. I'm capped around $6,000 of profit. Okay, but I'm risking $51. So that max profit is incorrect. Is that, let me double check something here. Oh yeah, that needs to be a sell trade. There we go. Okay, this is now correct. So what I'm getting at here is if I go $60 up, I can get a $60 credit on a trade that's going to cost me $40. So do the math on that. If I go $60 credit and I pay a $40 debit, that gives me a net 20 credit, right? So I can make max profit of $2,000. Okay. But my max risk on the trade, if price does not go to the full 66 to 76 to 80 some dollar move, that risk is on the trade. So I'm risking $4,000 on the trade if I did one contract. I just think that's a little much. I'm not willing to throw that much risk out there for a 1-day trade. So I'm going to use time, and I'm going to use the efficiencies of the market to forecast the expected move. And I'm looking to see if we can, in fact, get that 60 to 65 to $70 move. And what we have seen in the past is we've seen Netflix blow through earnings positively and negatively and have $70, $80, $100 moves. And if it does that, great. And you kick yourself like, oh, I should have gone long. But if you don't want to throw $4,000 at a trade, don't. There's other ways to trade it. All right. So anyway, it's just an earnings play. All right. There's other ones that I'm going to figure out. But to me, this is pretty cost effective. If I'm right, great. I'll make probably $400. If I'm wrong, fine. I'll lose $300. If I'm right, actually, if I want to hold it to expiration, if I'm right, I'm going to make about $1,400 and lose about $300 if I want to hold it to expiration. But the reality is I'm probably going to take a 650 credit and go after a percentage target. So if I have a 750 credit, okay, let's take a 15% take profit. If I made $1.12 in this position, that's hitting a 15% take profit, right? So I mean, a lot of times with my earnings plays, especially when they're very black and white and binary, if I'm doing 15%, 25%, 50%, those are all very mechanical ways to set profit targets. So if I make $1 and change, that's a good win. If I make $1.50 to $2, that's a good win. And just let the process that up, because I take these trades quite a bit. Okay. In my, my trading room so far this year, with a lot of earnings plays, we're at about a 72% win rate. which is not bad for earnings. And we've netted close to like $5 of net credit. So if you're in one contract, you're up, $5 grand for the year. A lot of times I'm taking, 2, 5, 10 contracts. So, adds up pretty nicely. All right. Anyway, got a trade in there on Netflix. I'll post that in my Telegram channel for my traders as well. Let's talk big picture here. Let's talk, I've got this little Pulver report watch list. This is what I'm going to be watching this week. Okay. So it's 10:28. I centered a trade around the SPX this morning for about $2.50 credit. Right now that trade is showing 220. I need this to get down to about 210. So we're pretty close. If I get this credit trading down to 210 or 210, 205, then I'll grab my $35 to $40 profit out of the trade. That's the idea. I think we're going to stay there for the morning. I think in the next maybe 30 minutes, that trade's going to be a winner, which is solid. But what I'm watching for this week, this is the SPX. I've got that chart alarm. I'll move this down here to that low. And then on the SPY, chart alarm set both ways. So do we, tap the high, tap the low, watching to see how the probabilities play out with those breaks this week. If we're struggling, let's say that we're very quiet today on a Monday, and we have directionally like a Tuesday, Wednesday. I mean, do we poke the highs? Okay, what does that mean? Well, if we poke the highs from last week, the probability is that price does not close below the low, or price does not even come back to test the low. Okay, so why am I watching this really, really carefully? Because if price doesn't do anything this week, that's still a low probability. Okay, the highest probability is price wants to test a high or test a low week to week. Like 60+% of the time we're testing highs. 30% of the time we're testing lows. Only about 12% of the time are we going to, test the high and test the low. So that's not going to happen very often. Or 12% of the time we test the low and test the high. Not going to happen. Okay, it's low probability is what I'm saying. So why am I watching this closely? Because if we stay sideways, sideways, sideways all week, it's just an indecision week. Everyone got all excited last week, making 5 all-time highs, which is insane. But I still look at the technicals, and this is what I was saying, I think, in the first 5 minutes of our session this morning. The market now has enough information to digest a couple of things that are really important moving forward. Okay, the Fed keeps saying the same thing, but the market keeps looking at a higher probability of a rate cut and now additional rate cuts. Okay, so did the market use all of its power to price it in last week with the SPY making all-time highs again, the Qs making all-time highs, but that aggressive sell-off on Thursday, it just showed that maybe large cap is going to underperform small cap in the next 5 or 6 months. It's very possible. That's why I put on the trade in the IWM. I'm going to take a chance in the IWM for, roughly $10,000 of profit for about a $1,500 risk. I think that's a pretty good trade. That's asymmetrical to me. Anytime I can get 2, 3, 4 to 1, I love those probabilities, or I should say love those odds rather than the payouts. It's just a risk. It's still less than 1%, but that 1% for me that pays, maybe 3, 4% is pretty good. Okay. So I'm watching these levels carefully. If we are not really getting any directions, this is what I'm going to keep an eye on for the week. Let me go into my other software here, see if I can get some levels. Here's a gamma level to watch for. And I'll see if anything pops up here this morning. I doubt we're going to get some big directional trades today, but here we are in real time. So let me get a number on this gamma squeeze. So 423, 351. All right. So I've talked at length about this with my trading rooms. I mean, this software is allowing me to get a nice visual roadmap where price can gravitate towards. I wouldn't be surprised if price is able to find, this level here, this level here. Price is clearly, 60 to 24 calls versus puts. Does it, break and go to crazy all-time highs? I don't know. I mean, to me, I'm looking at these levels. They're there. They're small magnets right now. But what I'm going to wait for is when these gamma levels get up to, let's say, 1,500 to 2,000 net. So that's essentially, it's a combination of, institutional order flows, hedge levels, and open interest. If that all happens, I mean, those happens intraday, those happens in real time. Yes, like last week, for example, when that Thursday sell-off happened, I had a big level right down here, and I took this trade. You can watch it. You can watch the recording of it. I had a level at 556. Okay. And so I put in a 557 put and I captured that sell off and I took profit. I did about a 65-cent debit that I closed out for about $1.80. So almost a 2 to 3x return on that position. So when it lines up really nicely, these trades are fantastic. So I try to be really patient on this stuff because, especially going single directions, DTE, you have a lot of risk on those trades if you're wrong, but obviously some profit potential if you're right. So
Hey,
I see
Chris.
Frank's in the room. He's ready to jump in here for about 20 minutes with me. What's up, dude?
How's it going?
Good,
I
man.
took your
How are you?
spot for like 30 seconds.
You what?
I took your spot on the screen for like 30 seconds.
Oh, I don't care.
Hope you don't
sent
mind.
me. All right. All good. What's up, man? How you doing? How's the weekend? What do you want to trade today? I was just talking about some short-term opportunities. I'm watching the high and low from last week's SPY. Did you know, Frank, that we had 5 all-time highs last week in the SPY?
I mean, every day it was like an all-time high. So,
Exactly.
I mean, except for Thursday, that was actually
Well, it was an
no,
all-time high because it
it
opened at
hit an
all-time high.
all-time high and then came
Yep.
like 2% back.
Oh, I know. And
Yeah.
that's what's funny though, is like we know that it was a terrible day on Thursday for the sell-off. I mean, SPY was down 1%, Q's down 2%, but the fact the market notched an all-time high, that technically, you got to give it credit. So 5 all-time highs is pretty impressive. But one thing I want to mention right here on the watch tool, this has changed a lot in the last couple of weeks. The market's now pricing in that we might have 3 cuts coming by the end of the year. Did you see that?
3.
So,
I did not see that.
3. So check this out. So initially, this goes back, we know that this changed from about 50-50 to now it's 88% that the Fed's going to cut in September. Powell's, 2-day testimony last week didn't change this probability whatsoever. This is likely going to happen. The market's expecting a cut in September. So if they cut in September, cool, it's kind of baked in, priced in, but this is what's changed. Look at the November. Another potential cut. Yeah. 56% probability going to December for 450. So you're at 4.5% with another 52%. So this market is now looking at 1, 2, 3 cuts, which I do think, I don't know, man. I mean, maybe the Fed does, but if we cut 3 times in 3 rate decisions in a 4-month period from September, there's no October FOMC, but if we have September, November, December, and this market is pricing in, and the market gets 3 cuts in 4 months, I do think that runs the risk of the Fed breaking something. I don't know, man. It's it's a lot of cuts around an election cycle. I think that makes it a little wild.
Actually, at first, the first rate cut when we were talking about it a few weeks ago, just seeing 1 seemed dangerous.
Yeah.
But now we're seeing 3.
Yeah.
It's hard to come up with some sort of justification, I guess. But if inflation continues lower with these cuts, I don't know, maybe Powell might be, I don't know, maybe they know what they're doing, but I'm not, I don't know. I'm not in support of a rate cut yet. I like what the UK did, where they got to their 2% goal and then they held rates because they wanted to see how, if it was sticky or not.
Right.
But here, maybe we're just cutting with falling inflation rates, and maybe that's good. I don't know. The fact that we're pricing in 3 is pretty ridiculous.
Yeah.
But yeah, we'll have to see it. It's very strange now that we're at 3 versus the 1 that might have come in September.
Yeah.
Do you think that's because, though, the odds of a Trump presidency has increased as a result of last Friday? And when he was president, he was an advocate for keeping rates as low as possible. Do you think maybe this is something that's going to, even if we don't get cuts this year, do you think that's going to be a potential issue in the future where, we'll get ultra low rates again? even with
It's very possible. I mean, so I don't think that the CME watch tool nor the Fed can price in right now. Why would they price in 3 cuts when we don't technically have a president? Like, we don't technically have Trump as president. And so I could see these forecasts changing, right? Where it's like,
Right.
oh, if Trump's president, like I could see that changing going into 2025. And look, the probabilities jump from about 59% to like 70+% as after this weekend. If we look at probably the biggest mover in addition to rates would be the dollar. I mean, if we're going to see a weaker dollar, that's how the stock market's going to go higher. And how do we get a weaker dollar? By slashing rates like crazy. So if we're looking at a 200 basis points difference from the Fed going from 5.5 to 3.5 over the next year and a half, that is a lot of weakness in the USD. But the one thing that it is, yes, we could have a weaker dollar, but does that necessarily mean that our globalization is going to be increasing? Because I think one thing with Trump in office is it's not globalized; it's deglobalized. We'll tax, we'll tariff, we'll weaken our dollar. We want the best of everything, but I don't know. I don't think we have the best trade relations or globalized trade relations with Trump in office. So, and again, that's up for debate. Some people like the fact that we get taken advantage of and all these trade deals or whatever, but it just seems like it's more closed borders, more nationalistic, and we want. I don't know. And if we want to make more money internally, we want to manufacture more. It's not going to be with people. I think that's maybe the scary part that people don't realize is if we're going to increase manufacturing and be this hub and we're going to make everything ourselves, the U.S. makes semiconductors, the U.S. makes cars, the U.S. does. We're doing it with automation. Like jobs aren't necessarily coming back in a big way. All the jobs that have been created this year have been government jobs and service jobs, right? And we're seeing service PMI going down. So I don't know. I mean, one thing that we've mentioned the last couple of weeks on the show is we're ticking up in unemployment, right? 0.5%, 0.7%. Those are not bad numbers. In fact, I was in Chicago this weekend, Frank, and I watched The Big Short again on the plane. And when Brad Pitt's character is Ben Rickert, right? When he was talking about, did you know that for every 5% employment, 40,000 people die? He told the guys to freaking stop dancing, when they're in the casino.
Yeah.
So, I mean, we're in that stage where it's like, look, people are losing their jobs. The labor market's softening. And yet we're sitting here celebrating it like, oh my gosh, finally this relief. I mean, those jobs don't necessarily come back, right? Corporate America is greedy enough that if they want bottom line, they're going to automation. They want to do more with less. I mean, that's how shareholders are happy. That's how investors are happy, because you have to do more with less. If you want to keep beating expectations and getting revenue, you got to find a way to cut expenses. So anyway, I just don't think
it's kind of a dire
rosy picture. I'm not getting doom and gloom. That's silly, because we're probably we're probably looking decent for the next couple of months. But look, the rate cut stuff, I just thought that jumped out of nowhere. That's very different than last week to see that the market's now anticipating another November and December cut. So
he's talking today, is he not? Or
Powell?
he already did?
Who?
Powell is talking right now, I think.
Okay. I don't know.
Oh,
I mean, I don't know.
At noon, he's talking.
At noon,
he does some open Q&A, I guess. But
all right.
Yeah,
he's not going to say anything different, dude. That
he's
guy.
Not, so I don't really understand what's going on with the forecast then.
Yeah, I don't know either.
That must have changed overnight or something.
It changed over the weekend. Yeah. So, I mean, I read this morning all that opening bell higher was, Trump trade. Well, okay, fine. But, we also had rate cut trade, and that's been kind of pushed in last week. We have Trump trade now. It's like, how much higher can this market keep pushing up? It's not real. We're pricing in things that might be happening, might get a rate cut, might get Trump as president, might get better CPI inflation data, might get higher on, softening labor market. But we have until September, by the way, we still have August. And so what we don't see right now is if we go to a calendar and we go into August CPI data, which I'm not sure what the date is, but I'm pretty sure there's no forecast for it right now. Let's go to next month and see when it actually is lining up. So let's go next month and look at August and look and see when is the US CPI. Because right now I'm looking at US CPI on the 13th of August. Jacksonville is going to be towards the end of the month. There's no forecast on CPI, but I can probably assure you of one thing. If
You
we
mean
don't
the
come in
14th?
with that CPI, or that's PPI on the
It's
13th.
the next day on the 14th.
So we're going PPI first. Okay. So CPI is on the 14th, my fault. I can say with a little bit of certainty that if we don't come in lower than 3.1, this market's probably going to have an adverse reaction to that inflation data. And therefore, everything we're talking about right now, these rate cuts and seeing all of a sudden September, November, and December, that can change. So I still think the Fed is data dependent. I think the Fed will completely push back on cutting rates. I think. I don't know. I mean, if the Fed cuts rates to the end of the year and they do cut September, November, December, they're cutting rates for probably a Trump presidency. I mean, after what has happened over the weekends, I don't think that the Democrats have a chance to win at all. At
Yeah,
all.
I saw the odds increased of his of the likelihood that he's president.
Sure.
Um,
And so there was that discussion of, oh, if the Fed cuts rates, that will help the economy, boost the markets, and then maybe the current incumbent stays in, Biden stays president. That's not going to happen. At this point, I think the country feels pretty let down that, a guy that's 80 plus years old with likely dementia, likely something of that capacity, is lacking the lucidity to be our president. It's just not the same. And so if the Fed was going to try to cut and be a political play to help the incumbent, it's not helping, because right now those odds are so much in favor of Trump likely being the winner, and I wouldn't be surprised if it's a landslide. It's rough, but it is what it is. So what does that mean? It's going to be interesting to see the popular vote versus electoral college, but I think after this weekend, the presidential election it's kind of a wrap.
what do you think that means for the markets then?
Well, same thing we just talked about, dude. I mean, Trump comes in as a Republican, and what is the Republican Party likely going to do? You're going to be looking for tax rate cuts or tax cuts. You're going to look for deregulation. You're going to look at deglobalization. You're going to look at weakening dollar. You're going to still look at a ton of fiscal policy and fiscal spending. So weaker dollar, higher markets, rate cuts, better profits for corporations. Top down, trickle down economics, whether that's good or bad. Look, if you own assets, Republican Party is going to help you, right? In my opinion, that's how it's always been. The inequality and the spread from those that have those that do not. I mean, these times in the market where assets go up, okay, the stock market is the ultimate hedge against inflation. Well, if our inflation data is truly going to still trend lower, those that have will see assets continue to go up. I do wonder what happens to the housing market, because if we see rate cuts, that's probably good for the consumer, for corporate debt. I think that's good for refinancing. I think that's good for housing. And so, the consumer can still get there, but we're at an all-time low in affordability. So that does change things quite a bit. I mean, if you look at we talked about this last week. If you look at a mortgage calculator for a $500,000 house, the difference between a 6.95% interest rate or a 4.95% interest rate, there's a big difference of whether you can afford that house or not. So again, 2% is out a year plus. So it's not like immediate cuts in September is everyone's buying houses again. But if people are buying with the intention of, I'll refi in a year, refi in 2 years, you're going to overstretch for a little bit, but you're hoping that rates get better. So,
which I mean, the rates could get better if they continue to cut, but
yeah,
if we get that increased spending and there's more money circulation and the consumer's back, inflation is not going to go down. So then we run into that same problem that we did a few years back. So I guess what I'm kind of trying to figure out is, do you think that we are really going to see like I guess Tom Lee talks about how inflation is going to drop significantly, almost suddenly, I guess.
okay.
Or is that necessarily true? Because if we have a flooding of demand back in the housing market, what is that going to do to inflation? And honestly, I don't think it's going to help it go down. if that's the case.
Yeah, that's a good question. I mean, for the housing market, I mean, the one thing that the US has that other countries don't is we truly have a 30-year fixed mortgage. So that's a lot different than Canada, where you have basically a variable rate every 5 years and you're refinancing at current rates. Like if you have a fixed mortgage, that's why right now, like that's why this, you know, that's why these markets have been resilient and sustaining with household numbers. Like household wealth is as high as it's ever been because everyone's home is 25 to 50 to 100% more valuable,
Yeah.
which is insane because it's, I mean, I don't know if let me see if I had a screenshot of this. I think I took a screenshot of this, but it was something on the just the pacing of like, let me see. I think I took a screenshot of it. I hope I did. All these screenshots. There it is. Okay. So price changes from 2000 to 2024. So let me just rattle some numbers off here. In the last 4 years, all right, hospital services have gone up 256%. This is more expensive. Okay. College tuition has gone up almost 190%. College textbook, 158%. Childcare nursery school, 140%. Medical services, 135%. Average hourly wages have gone up around 118%, which is great. Okay. But it's not outpacing the things I just mentioned. Food and beverage has gone up 100% in the last 4 years. Okay. New cars have gone up 24%. Household furnishings up 15%. Clothing 1%. Cell phone services have decreased. Here's your deflation, Frank. Cell phone services have decreased by 42%. Computer software decreased by 73%. Toys down 74%. And TVs down 98%. Everything else is more expensive. We're at all-time highs. I wish it said houses, because right now you look at housing markets, 25, 50, 100+% upside. Okay. Now our wages, average hourly wages for 4 years, 118%. They're not catching up with houses, right? House prices that have doubled, it's like that's a 200% increase. You know, I mean, our wages are not keeping us up with. Example being, if you bought a $500,000 house in 2020 compared to a $500,000 house today, that's a very different house. Have wages gone up? I mean, Frank, have you seen a big increase in wages? Have you made 100% more money in the last 4 years?
No.
No, I haven't either.
No one has.
Most people haven't. So, I mean, to see that and see that stat, it's like, well, I didn't double my salary. You know, I mean, maybe from the lowest end earners have moved jobs, switched jobs, taken on more gigs, and they're making more money. But it's not exactly mapping out to be like, oh yeah, that makes sense. Like everyone can afford expensive houses now. It can't. So inflation wise, I mean, I think that there's deflationary pressures, which are good. I think if the consumer just stops splurging and spending, inflation pressures come down. I think if our food prices and energy prices remain flat or stable, then inflation pressures come down. But I think the big inflation came from the government giving money out. That's really the big jump. And to say that, like, congratulations, everybody's got $600 or $900, that didn't do shit for anybody. But the fact that the government did that and spent X amount of billions of dollars to do that, that's where inflation came from. And we're still seeing that going through the system and still having to play out through the system, where that's how we got to 9%. So, I mean, I don't think we're doing another round of that type of stimulus. So it's just, I don't know, man. It's
a mess.
It is a mess. And look, the debt issue that everyone keeps talking about, this debt bubble for the US, is probably not going to change. It's going to be a debt problem, but what are we going to try to do with it? We're going to try to grow it. We're going to try to outgrow or outpace our debt. If we can have debt at X amount of percent, we can outgrow it because our GDP is at 2, 3, 4%. Maybe we can outgrow it. If our rates are at 5.5% and they drop to 4%, what's that help the Fed do? Not pay 5.5% on short-term treasuries. Not pay, on the lending rates. It's like the Fed's not going to be responsible for, trillions of dollars in paying back freaking debt. So, and at the end of the day, as world reserve power and central bank, it's like all this stuff can be reaccounted for. I mean, I'm sure the central banks have all sorts of creative accounting plans where if the proverbial shit hits the fan, there's ways that we can write off debt. you know, or the Fed can absorb it, or the government could absorb it. But right now we have a government that's spending with a Fed that's trying to be tight, and it's just, you know, and everything keeps moving. So I mean, there's no, I think this is a reality. There's no ceiling in place, and there's no floor in place. It's just everything is a moving target, right? Our inflation is a moving target. Our all-time highs are moving targets. The day-to-day movements and volatile, everything's a moving target. So the best we can do is just keep navigating to keep things probabilistic. As a trader, that's all you can do. So anyway,
Yeah.
that's a, you know, little segue, but I just think it's important to note. Who knows? I mean, if the market gets ridiculously excited, here's a good probability for this week. If we crack the highs again this week and we do it today or tomorrow, probability is we're going to stay higher for the week. Whether we,
I think we just did.
well, I've got the SPY right here. We're not at all-time highs yet.
Oh wait, hold on. Yeah, you're right.
Yeah, we're
We're
close.
getting close again. That Thursday drop was such a blip.
Yeah.
I was wondering if that was just a small taste of what might happen. I don't know
Well,
what that was, because they said it was a rotation, but I mean we're back to where we were. So
I know.
who's
It
rotating?
was, yeah. Is it? Well, here's what is this a, you know, one, is this a, you know, a bear market? Two, is this the, you know, the correction? Three, is this the, you know, large cap to small cap rotation? And the reason I say that is because if you compare the difference between the Russell and the SPY on Thursday, I mean, the Russell was up 3, 4, 5% last week. Everything else was flat for the week. You know, the SPY came ripping back on Friday in a ridiculous fashion, actually cracked the highs again, and then faded aggressively. Here we are back up towards the highs. So it's not a bear market. You know, correction would have been a single day correction. And here we are talking about the SPY at a 1% correction, Frank. 1% is not a correction, dude. You know, and 1% I don't think is a full-on rotation. There's still a lot of people buying Apple. There's still a lot of people buying Tesla. There's still a lot of people buying large cap, you know, but I think that what maybe, I don't know, what's the COT show? Is there anything with the Edge Finder for Russell? Do you guys have
Yeah,
the
let me
Russell right
pull it
now?
up really
What's
quick.
administrator showing for smart money?
Yeah, give me a minute on that.
Okay.
Because the week before, actually, money came back into the markets. What looked like a rotation out of it ended up being, I guess, almost a false alarm. But let me show you. This is COT this week.
Okay.
So they're getting out of tech and S&P and Dow. Meanwhile, small long positions on the Russell. And Nikkei is back up, which
Okay.
was like, it was like one of the most heavily sold for like 3 weeks or something, and now it's back up here. I kind of like the Russell trade. I think you and me talked about this before. That would be kind of like a catch up trade.
Yep.
With the rest of the market.
Yep.
But you know, I was happy to get out of my Qs. I was in triple leverage, and I was like, okay, we're pretty high now. I'm glad I trailed out. And then it went to like 84 or something, and I got out like 70 something. So
Okay.
it's like they just keep running higher. But I'm in I own this ETF in my Roth. So this has been doing well. I don't know if I'm going to sell it or not, but I do like the upside potential on small caps this year.
Mhm.
Hopefully this back half's gonna be good, but
Sure.
it's kind of just been, you know, very unexciting.
I mean, well, it was way less exciting for the last several months on the small caps, and just in the last week, it's gotten way more exciting. I mean, dude, the Russell's up 8% in the last like 3 trading days. So
Yeah.
I am hoping that technically this is a decent breakout. Where, so I don't know if you tuned into the session earlier when I jumped in around 10 o'clock, but I have a position on the Russell that right now my Russell trades are doing pretty well. I'm sitting here. I've got about almost $8,500 in profit on the Russell right now, and looking for more. So let me see if I go into, just go into positions here. Here we go. So my IWM's up about $9,700. So there's another, I mean, up $5,200 just on today's trading. And a lot of this is, today's a good P&L day. We're up again. My longer term trades, I've got a lot of ratio spreads, bull put spreads, and naked puts on the IWM. So a lot of those are now, because price is going up, those are all looking higher probabilities for profits. I can probably start managing some of those early if I wanted to, but I think if we're going to go up, those are probably looking better for expiration. The trade
Did you get signed on any of them?
No, because all my ratio spreads were out of the way. I mean, I was doing like out of the money bull call, credit spreads or ratio spreads where price had to come down way, way, way farther. So my DIA, my IWM, my Qs, my SPY, my Apple, my Google, my Microsoft, none of them got assigned. All my ratio spreads were looking like for full profit. So
cool.
Yeah. So really quickly on IWM, I took this trade this morning. So it was fairly inexpensive. Okay. I went out to February of 2025. So I'm giving this market the time to catch up. I'm giving this market, the end of the year type Q4 rally. I'm giving those open interest levels and those big gamma squeeze levels in December to in January. We have this thing in options called Vantage Arms. And so if those are all like hitting those big, big targets, like the SP at S&P at 6,000 or the SPY at 600 plus, the Russell, if we just look at the all-time highs, that was at 244. Okay, we'll call that 244. So what I did was I did a 240 and a 245 long call. Now, those are out of the money, and historically, they finish out of the money. 73% of the time, they're going to finish out of the money. However, if this is going to catch up like we did on that rip in Q4 of 2023, the Russell can go way faster than the SPY and the Qs, right? Like, I mean, this thing went up 30% compared to like 18 to 19% in the other indexes. So if we are getting this rotation and this is truly going to be a breakout trade, then I'm looking at this as over the next 3, 4, 5 months, if we're sitting at all-time highs or close to the all-time highs, to me, this is why the catch-up trade looks so attractive, because it's measurable. You can see all-time highs right here on the chart. Look left, and if that's where the market's going after for a destination, look, I'll take the fact that it's a lower probability trade, but if it pays me, it's going to pay me about 4 to 1. So I'm risking about $1,400 to make about $9,000. I'll take those odds on a setup. And again, could I be wrong? Sure. But I think if we're going to get a catch-up trade and truly get it, the risk reward is in my favor.
Yeah, no, I'm in agreement with you. Hopefully we do see it back up there.
Sure.
But we have James coming on at 11,
Yep.
I think. So
okay, that's cool. I got to run. I
got
got to take the little Frenchy boy to the vet. So I got to run here. But I'll see you guys later.
Poor guy. All right. Thanks for hopping on.
Right. Thanks, Frank. Thanks, guys. See ya.
See you.
Bye.
We often get asked by our US viewers, how do you guys trade gold and indices on a regulated broker? To trade gold, indices, and more, we trade using Webull. And for US citizens watching now, for a limited time, you can get free stocks if you use our promo link that can be found in the description or dropped in the live chat right now. Webull is our top pick and personal choice when selecting a broker here in the United States for stocks, indices, and commodity trading specifically. Get your free stocks now by clicking the link and signing up using the instructions found there. Now, back to the show.
Hey guys, how's everyone doing? Let me just sort the camera there. Cool. So, yeah, it's been interesting. I'm sure you've already heard the week breakdown, what happened over the weekend with Trump and things. So I won't go into that. I thought I'd want to start repeating things, but yeah, we did see quite a nice move on the dollar. So let me just pull up the dollar index here. So obviously we had the market gap on market open, so that was a nice sign that we could potentially start seeing some bullish moves on the dollar. And although I've been saying that I am a bear on the dollar, which I am, but I do see potential bullish moves coming. We do have actually, let me just pull it up one moment. Where is it? Unemployment rate is still low at 4.1%. So It is upticking. Let me pull this up actually here. So obviously unemployment is increasing, but 4.1 is still not a large amount really. So it's not necessarily a concern. However, it could be something to keep in mind as we go forwards into the future. But over the short term, it's not necessarily something to worry about. We also have CPI, which could be a sign that the Fed might slow down or pause rate hikes. Obviously, we are kind of expecting rate cuts in sort of November, September time. That's kind of the word on the street now in the bank reports. So obviously that is bearish for the dollar. But yeah, again, in the short term, we could expect some potential bullish moves, basically just relying on the current rates in the US. I also would like to see a correction of the move that we see here on the left from Thursday. I think that the dollar is at quite a large discount at the moment, and obviously just relying on very basic technicals, we are at quite significant support on sort of the daily, the 4 hours. So some sort of natural sort of correction of this, and then possibly a continuation to the downside from there would make sense for me. In terms of what's actually on the watch list, we have the Euro Australian that I really like. So we can see on the daily here, we're rejecting this 21 EMA. We also have the fib here with the golden zone that lines up really, really nicely with this level of resistance. So I'm just waiting to see if we could potentially get a slightly higher move on the Euro Australian. We have already had this sort of testing period of this level, so it wouldn't be a surprise if we don't get to this level again. We are also quite close to the 200 moving average as well now, which could be a sign that we are starting to see sort of the potential top of this and then a continuation to the downside, in which case I'll be targeting this 1.58 level at the fib extension, which is at this sort of level around here. So maybe just a slightly higher take profit actually. So possibly something around here. And that's still a great trade, to be honest. If we could get sort of a, let's see, sort of a roughly a 1 to 3-ish, I think that'd be fine. I'd be more than happy to take a trade like that. NASDAQ, I think, you know, everyone's looking at the NASDAQ at the minute. I would have liked to have seen a deeper pullback, to be honest. This wasn't large enough. I think, you know, we could all agree that this isn't a healthy pullback, should we say. Obviously this was a news-driven move. It wasn't sort of a natural correction of the market. So I was ideally looking for this sort of 20,000 level to get hit, and it just wasn't. You can see I've got an alert set just in case it does. We might see some sort of pullback here. However, it doesn't look too likely at the minute. We are seeing price rocket to the upside. It has been all day really. So not much hope on this one. I think NASDAQ's one of those trades that we have to, well, I just have to sort of sit and watch with a bit of FOMO, but there you go. That's what it is, unfortunately. The Euro Canadian, this one, again, very, very simple trade. Just looking at the market structure. So we can see we've got a nice sort of level throughout here that was used as resistance very briefly, which is now turned into support. Then turned again into resistance. So I'm now just looking for some sort of pullback into this level, and then again just looking for the continuation to the upside. But yeah, it's not looking too likely, to be honest. I'm not sure if we're going to get a deep enough pullback to warrant an entry, just because we're on such a run to the upside. We're seeing very strong markets at the moment, a lot of bullish moves. So the pound dollar, I won't go into this one again too much, just because it's not necessarily a short-term trade. There's quite a lot going into this one. However, I do, you know, I've explained it on my Twitter account quite a lot, and essentially it's just relying on a weaker pound going into sort of the end of 2024 into 2025, and also using sort of the Fed cuts as possibly a catalyst for this. Now, obviously, that would weaken the dollar, so that might not make sense. But to me, you know, just using some sort of news event to get into a position would be ideal, really. But again, it's just too premature at the moment. We need to see a slightly higher price. and whether that's this huge sort of weekly and daily level we have up here, which is the sort of 1.42 area. Yeah, I'm not sure, or the sort of more minor level we've got here at 1.31. The issue is I just don't see this 1.4 level as being realistic. We're over halfway through the year. And I think that we should be a lot closer to this level than we currently are if this was going to get hit. I don't think it's a realistic target right now, to be honest, even though the pound is doing quite well for itself. The pound New Zealand, this one again, just relying on some short-term bullish pound. We've got stability with the political side on the pound or in the UK economy at the moment. However, I don't think that's going to last, but we may as well ride the momentum while it's there for the short term. So if we look on the H4 here, you can see price is very, very extended at the moment, very deviated from the 200. So 200 moving average right here. So we're about, 2% above, which oftentimes means we will see some sort of mean reversion, which means we'll see a pullback to sort of an average price and then a continuation, or sort of relax and stabilize this move. So I would like to see a pullback to this level of support. In terms of targets, I'm not looking for anything too huge. So possibly just back into this level. However, I have a feeling we've missed this move. I'm just not sure we're going to get such a strong pullback. So we'll have to sort of see where price tops out at, and then use a fib to possibly gauge some sort of entry from there. However, there's no structure here really to back this up, so it may just be sort of a no-go trade and one we watch from the sidelines. Low audio. Let me have a look, see if I can boost it. Can't hear. That's strange. I'm not sure why that would be. My settings haven't changed. Yeah, I'm not sure. I've just boosted it in the settings on here, so maybe that's helped. But yeah, other than that, I'm not sure. I'm not sure how. Maybe just turn your volume up. So yeah, I'm not sure how realistic this move is to get such a strong pullback. But again, it's worth watching. But I've not got too much hopes on that one. So yeah, I think overall, these bullish moves are very, very good if you're already in them. However, I'm not, so it's a bit painful to watch these because obviously, we've missed them and now just looking for pullbacks. I'm just not sure how likely that is. I mean, if you look here, we've got this really nice level of structure. So obviously resistance turns support. And then ideally, in a perfect world, we would have seen a rejection of this resistance and then a continuation to the upside, a break and retest on this level. But of course, that hasn't happened. So yeah, it's a case of just looking for pullbacks. Prices at the moment in a lot of the markets are very, very extended. I'm a bit unwilling to say overbought. However, they do look quite overbought in my eyes. Pound Swiss, this one is also looking very, very nice to the upside. Of course, the Swiss is one of the most shorted assets on the COT scanner on the Edge Finder. Let me just pull it up and double check. It still is. It might have changed by now. I'm not sure. I don't think it will have done, actually. Yeah, so you can see here, the Swiss 90% short, and the pound is 72% long. So makes a lot of sense to go pound Swiss to the long side. Of course, like I said, we've got quite a strong pound due to some political stability now. So essentially, there's two things we could look for here. Either a pullback and then a continuation and sort of this break and retest, in which case I'd be looking to enter on this pullback. Or we could see this and then continuation to the upside. So obviously just a break, clean break above, and then enter on this retest. Which, to be honest, I think this one is more likely, this sort of break and retest. I just don't think we have the sort of selling pressure in the markets to have such a strong pullback. And during this retest here, this may give the moving average is sort of price time to stabilize and sort of correct itself. Australian CAD, not too much of a fan of this one at the moment, although, you know, the Australian dollar is very bullish, so looks fine. However, technically it's just not the best. We do have a nice structure here, but again, I just don't see these pullbacks as overly likely right now. So I'm kind of just sitting on my hands. I've got one position open on the dollar against the Mexican peso, but I can't show that one right now. We did close silver as well, so I can show you that one. Now, Australian dollar against the US dollar, I really like this one. I would love to see a pullback down to this level of resistance. I think this one is very, very textbook. It's almost, you know, if we do get this pullback, it would be one of those trades that it's kind of no-brainer. You would just take it, or I would just take it anyway, because it's, yeah, very, very what do you call it? Yeah, textbook break and retest. Gold, I think everyone's looking at gold at the moment, as well as the indices, especially Nasdaq. Gold is on a huge runner. Now this is, you know, same factors as before. We've not really had anything change with gold. We did have, obviously, the attempted assassination on Trump, which likely put some fear into the markets. But to be honest, I think that's a little bit overplayed. You know, it's done. It's happened. Nothing, you know, Trump was unharmed, relatively unharmed, apart from his ear. Obviously, there was one unfortunate casualty, or death, should I say. But overall, in terms of economics and markets, I really don't think it's worthy of having much movement. You know, if he died, that would be a completely different story, but he didn't. So, yeah, moving on. I think, you know, my stance on gold has been the same for the past couple of weeks, which is I would need to see a break and retest. So a break of these all-time highs, a retest of this level, and then that would warrant an entry for me. Now, I wouldn't be taking gold at full risk, just because we are, you know, if this happened, it would be pretty risky. You know, it wouldn't be a shock if we did break all-time highs and then come back down. Essentially the same as what we did when we did break, have these all-time highs, when we formed this level of resistance. Now we just shot to the downside, really. So you got to be very cautious of that. You know, gold isn't just a bullish train. Although the trend is overall bullish, it doesn't mean that it can't have some pretty fierce pullbacks that you could easily get chopped up in. So this area is very important. And if you are, you know, if you are for some reason a bear on gold, then this would not be necessarily a bad place to potentially look to short. Although, you know, like I said, I'm not looking to short. I don't think that's a very wise decision. And then last pair on my watch list is Australia and New Zealand. You know, same reason. Basically, we've just got the very strong Australian dollar. I think we are due for a pullback. If we look at the deviation between price and the 200, we are 1.6% above, which to me indicates that we are overbought. We need to see some sort of pullback here. Stop loss just below this low, just in case the price does come down and correct this move here. And then take profit, where would take profit be? Let's see. Yeah, potentially up at the previous highs around here. But that's essentially it. All I can do is show you our silver position. If I've still got that marked here, which I don't. Let me see. So yeah, we closed out of silver here. We sent a few different trades here, so we allowed people to scale in and things, but I only took one position. So I got out of this roughly 0.6% gain, so nothing too huge. I closed somewhere around here, but yeah, that's that really. There was no reason to close silver. If you are in silver, I'm not saying that you should go and close it. I'm not saying that there's a bear market is going to start. It's mainly just because we wanted to free up some of our portfolio. We wanted to reduce our exposure, so we could enter into some other positions. So yeah, that's about it really. So we can go into, I see someone's asking for New Zealand dollar. Forex Guru. People are saying there's no sound, but other people are saying it's fine. I'm not sure what's going on. I don't know if it's my end or if it's you guys. I'm not sure. Because my settings haven't changed. let me just see. Yeah, nothing's changed. So New Zealand dollar. Let's see. I don't really trade the New Zealand dollar too much. Sound works great. Great. Good stuff. Okay, so New Zealand dollar is kind of in a range, to be honest. It's not something I would go out of my way to trade. I'm not really a fan of where's my box? I'm not really a fan of it when markets essentially just move sideways. Same as what gold's been doing, essentially. There's not really anywhere here technically that I would want to enter. But we could take a look at the Edge Finder, and we can see if there is anything on here that would back up a trade. I'm fairly sure the New Zealand actually is quite bearish at the moment, so it would make sense to go short. Yeah, here we go. So COT data is short, retail sentiment's pretty balanced, however, hedging towards the long side. Trend reading is bullish, sorry, COT's bullish. Seasonality is bullish, trend reading was trend. Yeah, so yeah, COT is long on the New Zealand dollar. Looks of it, was it short? Yeah, okay. So overall, I'd be looking to short. Sorry guys, I've only just got to the charts. I've not really done too much over the weekend in terms of research, so I'm just trying to catch up while I'm with you. So yeah, overall, I would be looking to go short. In terms of technical levels, I'd be looking for just sort of these lows down here on the H4, so around the 0.59 level. Stops above the previous high, so somewhere along here. But yeah, I mean, for me personally, I wouldn't be taking this. Obviously, it depends on your strategy. But yeah, so dollar yen. Yeah, so I'm actually in dollar yen to the long side. So actually, what I'm going to do is I'll show you my actual trading accounts, so I'll give you a bit more perspective. So you can see we've got the analysis here. So just looking very basic technicals, we've got this nice level of structure throughout here. We've got a pretty clean trend line, obviously to the upside. Very, very simple stuff. We've got the RSI that's oversold. And of course, the economics towards the dollar yen are bullish. It's one of the cases where I'm treating the yen pairs more as an investment rather than as a swing trade or a day trade or anything. So as you can see, there's no stop loss here. And that's because it's essentially one of the ways I trade. I've got multiple positions on different assets that don't have stops. And it doesn't mean, just because there's no stop, it doesn't mean I'm gambling. It's more a case of I'm happy and I'm very, very confident that this market is going to continue to the upside. You can see I've got take profit here at sort of the 165 level. That's my sort of target by the end of summer. And no matter what happens in the dollar yen, I'm just going to keep buying. So even if it dips more, I'll just add on more. And it's because I'm a fundamental trader, not necessarily a technical trader. And sometimes to be a fundamental trader, when you are looking to trade over the long term, rather than having stop outs and having to re-enter and having to look for new entries, sometimes when you are confident in your analysis, it can work out that you can just keep placing positions, obviously with managed risk and things, and just wait for the trend to kick in. As you can see, this market is very bullish. There's no way I want to sell, and I'm happy to just let this run. Now it's the same with the Australian yen. So I've done exactly the same thing here because we've got a very, very strong Australian dollar. The yen's obviously very weak. This is quite literally a case of buying strong, selling the weak. So it's very textbook. I'm very happy to just sort of sit in them and watch the ride. US 30, you are long, sure. But a bit confused about the volume. If it's low, I just can't work out why. Anyway, we'll move on. So US 30, you can see I was looking for an entry down here where I've got this alert set that was never triggered, unfortunately. However, US 30 to the long side makes a lot of sense. Let's see. Yeah, so daily's bullish, monthly obviously bullish. The H4 is bullish, so definitely not upset about buying the US 30. You know, I only ever go long on the indices, so it makes sense. But yeah, it looks fine. I would potentially expect some sort of pullback, but that's because, you know, I'm a pullback trader. I like to see them just to enter the markets. But yeah, I would like to see some sort of movement down to this level, and then a continuation higher. But if you are already in long positions, don't worry. I wouldn't be looking to necessarily close out, but just secure positions, make sure your risk is managed and things. Of course, this isn't a financial advice, just my outlook on things. We've already covered gold, the New Zealand Swiss. If you want to rewind, you can see gold. So I don't like New Zealand Swiss as well because both currencies are quite weak in my opinion. I'm not looking to buy either. I'm actually quite bearish on both of them. You know, the Swiss is very short. The institutions are 90% short on the Swiss. New Zealand dollar is not doing too well either. So to me, not a fan. I mean, you can see by this price action, there's not really much here, just sort of sideways movements. In fact, we've not really had a trend since this one here. The rest of this is, you know, we've had a slight move to the upside. However, it's been very messy. Trying to sort of trade this, especially based on technical levels, would have been very difficult. Definitely not something I want to be involved with, to be honest. So, yeah, I won't I won't really go into it too much further, unfortunately. Pound dollar, we've also covered pound dollar. So short term, I'm looking to go bullish. I'll cover it again because I think I might have skipped over it a bit too quick. But yeah, I am looking for the sort of 1.315. Wouldn't surprise me if we reach there. Like I said, we've got quite a strong pound at the moment. We've got the stability with political things and sort of hope in the UK economy, although I disagree with that. I think that the economy is very difficult, and I think, you know, it's in a very hard place, and I don't think that Labour is necessarily going to fix those issues. However, with a new government coming in after 14 years, and already these problems are obviously pre-existing, though of course there'll be that hope. I don't know what's going on here. I think my camera keeps freezing as well. Having some technical difficulties today, guys. I'm sorry. So yeah, where was I at? So yeah, short term bullish on the pound. However, long term definitely looking to go short. What I can do is show you something actually that. Let me see if I've got it. I might not have it anymore. Yes, I do here. So this is a bank report from UniCredit. So if we look, we remain bearish, especially looking into 2025. And they're referring to the pound. So obviously there's a lot of information in here. I won't go through all of it. But yeah, overall, they are looking to short the pound into sort of the end of 2024, start of 2025. So we look at the conclusion here. The sterling reapproached 128 against the dollar following the outcome of the UK general election on the 4th of July, even anticipated beyond the 0.85 against the euro. Nonetheless, the pound picture remains bearish, especially looking into 2025. Stretched public finances and self-imposed fiscal rules leave little room for action on the fiscal front. Hence, looking ahead, the intensity of a Bank of England easing cycle and the consequent move in interest rate differentials will likely remain the main driver for the sterling in our view. We expect the Bank of England to start cutting rates in August and to cut quickly afterwards to help a still flattish UK economy. We thus expect the UK base rate to end in 2024 at 4.5 and to end 2025 at 2.75 from its current 5.25. Sterling remains undervalued with respect to the long-term fundamentals, yet it is more intense Bank of England Yet the more intense Bank of England easing we expect with respect to the Fed and the European Central Bank will probably drive the GBP USD towards 1.2. So as you can see, my target is at 1.2 down here. Sorry, is it? Yeah, 1.2. So that's sort of very basic overview of that. You can also see that the euro pound as well. So yeah, very, very basic overview there. Obviously not gone into too much details there. Powell speech XXX USD buys. Why do you think that, FDL? Can you justify why you think that, or is that a gamble? Not trying to call you out, just curious. So yeah, actually, let's just see the DXY again, or the dollar index. Yeah, so we've seen very flat movement on the dollar today, actually. Very, very little movement here. We did see, obviously, like I said at the start, we've seen the gap, but since then, very little, just up and down, not really in either direction. However, we have broken out of the sort of flag, I guess you would call this. I think that's what people call these patterns. But yeah, I think definitely due for some sort of pullback, whether it's due to news or whether we get some natural sort of market movements. It wouldn't surprise me. So I am looking at some bullish trades, some dollar bullish trades. So if we look here, we've got the dollar Mexican peso. I know I said I couldn't show you this, but it's fine, I think. So we are long on this. For now, it's only a short-term trade. You know, we're not looking to hold this into, not looking to hold this one for too long. It's more of a sort of intraday position for this week-ish. Guys, I blew the full 1K. How did you blow 1K? You can tell us how it happened. We might be able to give you a helping hand to avoid that happening again. So we're also in the the euro pound position here. I think I showed you this trade last stream that I was on. So really clean, actually. And again, this is just running mainly off some instability within Europe and then counter stability with the pound. So we did come down to this level of support. Now seen sort of a failed breakout. We did see the RSI become oversold as well. And again, as I've been saying, we see this sort of deviation. We've seen a large distance between the 200 moving average and the current price. So pullback very due, to be honest. However, I do see this continuing to the downside a little bit further. Thoughts on a gold sell-off? So gold's interesting. I'm not saying we couldn't see a gold sell-off. Sorry guys, 1 second. Okay, so sorry, I just need to read a message. So gold sell-off wouldn't surprise me. Camera's frozen again. I don't know why that keeps happening. Very strange. I apologize about that, guys. It's been a bit strange. So yeah, anyway, we're back. So what was I saying? Gold sell-off. I don't see that as out of the question. So let me pull that up and I'll show you why. Because as I was saying earlier, when we get to these all-time highs again, or even if we break these all-time highs, we might see a lot of profit taken by larger market participants, or even a lot of people in general. And of course, that can drive some lower prices. But that wouldn't necessarily mean that the gold bull run is over. I think that we'll see gold is bullish sort of until the end of the year at least. And especially as we get closer to US elections. But I mean, it depends what you define as a sell-off. You know, if we see a sell-off like we saw here, then I see that entirely possible. But if you mean a sell-off, you know, back down to sort of these early 2024 lows, then I don't really see that as realistic at all. Especially yet. Might happen in the future, but right now I don't see that really happening. Right, let's have a look at these comments. Let's see. You got too confident and used 2.5 lots on 1K. The money wasn't yours. It's your auntie's money. That's crazy. So first of all, don't trade someone else's money if you aren't ready for that pressure, because it's, trading someone else's money is very, very different from trading your own money. Unless you're trading on the behalf of a high net worth individual, it's very stress inducing. So that's your first mistake. Second mistake is trading a very small account with a very high lot size. And now you're freaking out about it. So tells me you're not ready to be trading high lot sizes. You're not ready to be trading someone else's money. That's basically what it comes down to. You need to step back, I think, and sort of take a look at what you've actually done, and take some accountability for it, and then try and move forwards. But yeah, I mean, you're gonna have to work a 9 to 5 and pay it back. If you blew the whole 1K, if you had 1K and you blew it and you've got like $50 left, I'll be totally honest with you. You may as well just try and gamble the rest and make it back. The worst you can do is just lose the rest of it. You've already lost most of it. And I know that might be controversial, but that's the way I see it. What other option do you have? So UK trade unions planning to strike in September. I wouldn't get too confident in the pound. Yeah, exactly. I really don't like the UK. I don't like the economy. I don't like the politics. I don't like the currency. I think that a bear move on the pound is coming, and I think it will be huge. I've been talking about it a lot on Twitter, and to be honest, I'm the first one, other than sort of one or two bank reports here and there, to be sort of openly saying that I'm bearish on the pound. Thoughts on the Fed today? I don't have thoughts. I'm very neutral in the markets. I don't think about anything before it happens. And by that actually sounds really bad. I always think about trades before I go into them, obviously. But what I mean is I don't really go into news with some sort of idea or bias, because I think that can be a bit more dangerous. So I'm happy to just go into the Fed speech, see what it says, and react afterwards. Same lot size, different balance. Will it affect the value of the trade? Nope, absolutely not. You could have a $5 million account. You could have a $500,000 account. If you trade 100 lots on both accounts, the result will be exactly the same. And the same goes for a $10 account and a $1,000 account. 0.01 lots will be exactly the same. So both accounts will profit $2 or lose $1 or whatever it may be. Gold recap. We've already discussed gold. You feel depressed. What can you do to feel better? Yeah, FDL is right. You need to take a break. You need to get off the charts. Go and do something else. Forget about the money. And then at some point, you're going to have to look in the mirror and realize that you made a big oopsie. Well, to be honest, bro, I can't even deposit 500 USD and try to bring it back to 1500. That's the exact mindset that got you into this problem. That's the problem. That is the whole issue. Why does your mind automatically go to trying to flip $500 into 1500? It's the wrong way to approach the markets. The markets aren't here to make you rich. The only people that really make money trading are people that are already wealthy. And it's not because of necessarily a money thing. It's more because they understand the way that markets work and what they're here for. So in the FX market, actually, let me show you something that may help you out a little bit. So this is a tweet I put out today. So yesterday I tweeted this. It's much more profitable to trade the exotics markets compared to the major FX. And I'll explain why. So G10 currency pairs. Does anyone know, obviously I've just hidden it, but someone may have read that already, but does anyone know, and can anyone tell me what the G10 and the developed markets are used for on a primary basis? So you could say, obviously speculative trading, investing, hedging, all sorts of different things. Can anyone tell me what their main use is? And obviously don't say exchanging currencies, because that's quite obvious. I'm just going to show you anyway. So the G10 and the developed major markets are, let me find it. Yeah, so here. The FX markets are renowned for their liquidity with trillions of dollars circulating daily. But why is this the case? Primarily, it is due to large corporations hedging their cash accounts. Now, what that means is that, no, it's not liquidity, FDL. Well, actually, it is. I can't say it's not. Technically, it is. What was I saying? So yeah, hedging their large cash accounts essentially means, let's say that Coca-Cola, Apple, Microsoft, all these, large corporations have, these are all American companies. They have, I don't know, 200, maybe $1 billion sat in their accounts. They're not going to just leave $1 billion just sat there. They often hedge it with different currencies. So essentially their money doesn't lose value, or it loses value slower, and they can allocate it in different places. They can also then make international transactions in a lot more of a smooth way. So rather than having to convert dollars into yen, for example, every time they want to do a transaction, they've got a cash account of yen. And these transactions happen every day, all the time, essentially. So this is why trading things like the 1 minute and the 5 minute are extremely difficult to do, or extremely difficult to make a profit on, because a lot of those movements aren't due to economic factors. It's not due to news. A lot of these movements that you see on the 1 minute and 5 minutes are just transactions. It's just corporations moving money up and down and up and down. There's no necessarily no direction. Now, I say that here. So while there is money, there is large amounts of money going into these developed markets. It's not necessarily a positive thing. It's not negative, but it's not good necessarily for the average retail trader like you and me. And that's because this money isn't being put into trades. It's not Coca-Cola or Apple saying, oh, I think the euro dollar is bullish, I'm going to buy it. It's just there in their cash accounts. They're not speculative traders. Whereas if we look at emerging markets, so things like the USD TRI, we can see here we've got the trend on the USD TRI, and we compared that to the US dollar. The euro against the US dollar. I'm fairly sure you can all spot a huge difference between both of these markets very, very quickly. Which one would you prefer to trade? Because to me, it's the US dollar TRI. Very, very clear. So yeah, emerging markets are predominantly influenced by speculative interest, which is obviously used to gauge the market sentiment. So yeah, anyway, I mean, that was a long roundabout way of what I was actually trying to say. But the point was that these markets, so euro dollar, pound dollar, gold, all these things, they're not necessarily there for you to try and flip accounts, or they're not there for you to try and flip accounts. Normally these assets are here for hedging cash accounts. These are just price fluctuations, So my point is, change the way that you see these markets. They're not here, and you shouldn't be thinking of them as a get-rich-quick scheme or taking people's money to try and trade it. You really need to sort of zoom out your perspective and realize, that it's a lot more complex than that. My X handle is the same as my name. If you just search Forex James, I'll be there. I think that's about it. That's all I've got to really say. If you guys have got questions, I'll be happy to answer them. I'll give you a couple of minutes to ask anything if you need to. But yeah, in terms of the markets, I think that's about it. It's an F up feeling, it's an F up feeling when it's not your money. Yes, it is, absolutely. I trade investor capital, and it's one of those things where if you're not, how do I explain it? If you're not cut out for it, it's a very, very hard, it's a very hard thing to do. Because when it's your own money, you can put some more money back in if you lose it, or you can take that time and do what you need to do. Whereas investor money, you obviously have that pressure. I'm assuming you're not sending investor reports and balance sheets and things, because I'll be totally blunt. I don't mean this in a nasty way. You sound like a very quite an amateur trader. So trying to explain that you just lost all the money is very difficult. What's the highest profit you have made? That's a good question, actually. I'm not sure. Highest profit I have made, actually, I can show you. I can't show you the actual statement. I don't think I've got it on hand, but it was during, where was it? It was during the Ukraine and Russia situation. I think it was around here. Oops, zoomed in way too far. I made about 11% off that move. I think it was here. I may be wrong. I can't remember the exact date. So it was about an 11% trade. I think it went up to about 19%, but I was left holding the bag a little bit. But yeah, it was, I think it wasn't huge. You know, if you're used to all these funded trades and things, it probably sounds quite small, but I think it was about 9,000 British pounds, which was very nice. But you know, that's not everyday gains for me. So how much are you in profit this year? I can show you. So this is my company portfolio. So this year we're up just under 21%. This is slightly off. I've not updated it for July yet. It's probably slightly lower. I think we're actually in negative this month by a little bit. Not obviously not much. I think it's 1 or 2% we're down. But yeah, this is the way we track our trades for the company. Toby, hello. So yeah, last thing, guys, if you do want any questions answered, ask now. If not, I'll head off. I'll leave you guys to be to enjoy your days. After night short stories, you can give advice when you're ready to give advice. You know, I wasn't always like this. It took me a long time to get to where I was, and to be confident and comfortable in the markets, because you get to a point where there's a strange thing. I'm not sure if Nick will have gone through this as well, but you have a point where you're confident to do what you need to do. So trading for yourself and doing your own analysis and research. But then when you start putting it out in public and start showing more of what you do, it becomes a bit, you start second guessing yourself sometimes. It's like, oh, did I actually get that right? Is someone going to call me out and I'll look stupid? I mean, obviously that's not, it doesn't happen. It very rarely happens anyway, I think. I don't think I ever really see that. But it's just that thing of when you know people are watching, it becomes quite difficult sometimes. Yeah, so yeah, I agree with Will. No one, I could sit here and show you the way I trade, and my strategy and things, but it won't work for you. It's purely because, I take profit, stop loss, and generally just don't touch it. Whereas if you don't have the confidence in the strategy, which you wouldn't, so if I gave you my strategy and said just place the trades and leave it, you probably won't do that, because you won't have the confidence I have in it, because I'm the one that made it and back tested it and knows it works, not you. So yeah, you need to hit the drawing board again, I think. Anyway, guys, thank you for having me. I'm sorry that we've had some technical issues. Thank you for having me. Been a great chat as always. I will see you guys again very soon. I'm not sure when I'm next on, but I might be on again this week if the A1 guys let me. Is it fine to say gold is going to sweep buy side liquidity then move down? That's my sign to go. So I'll see you guys later. Thank you guys. See you later.
All right. And there we go. Real quick, we're just going to run a quick break. We'll be right back. The show's going to continue as we get closer to the Powell speech. So stay tuned. We'll be right back. If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show. All right, guys, welcome back. Hope you're hanging in there. We're back for another one here. The second stream of, well, my second portion of the stream. Stream's been going on. We're on 3.5 hours in. Hope you guys enjoyed the other guests. It's always cool to just get a bit of a rotation. As you guys just saw, if you're someone in the US looking to trade FX, check out Oanda. I've used them for years. Great brokerage, great people there, super regulated. And at the end of the day, for my US friends who trade FX, if you are wanting to trade currency pairs, like Oanda is the only option, in my opinion, because if you're trading offshore, your account could get shut down at any moment. It's not worth taking the risk with your money. You're trading already. It's hard to make money trading. You're taking risks every day. Why risk not being able to withdraw your money at all? Oanda is super regulated. So yeah, check it out. If you're in the US, definitely check out Oanda. If you're not in the US, a couple other brokerages, you could check out 8cap. Maybe we can drop the link to 8cap, and we'll just do a couple different broker options for you guys. One thing you could do, if you're somebody who's looking for a broker, we've put together this cool page. In fact, I'm going to drop the link for you guys here in the chat. Check this out. This page might help you out. My team and I, we've put together this page, which helps you to, based on what country you're in, find a brokerage that has the best offers for you. The reason this is worth taking a moment to look at is because a good sign-up perk is like free money, right? You can get like free shares when you sign up, or a deposit bonus when you sign up, or free access to products when you sign up. If you're somebody who's looking for a better broker, take 2 seconds out of your day, check out a1trading.com/brokers, and you might find something on there that's like, oh, heck yeah, I'll do that because then I'll get this deposit bonus or whatever. So all the details can be found here. You know, if you're in the US, you can check out the 2 brokers and the offers that we have there. So each one with specific links that are on these pages have been worked out by me and my team with our different partnerships with these brokerages. They're special perks. So Warner's Way says, very nice. Yeah, don't miss it. I'm telling you, it's if you're like open to switching brokers, definitely, like, brokers want you to sign up with them. You might as well get something like special in return. We have several offers on our website. Just wanted to throw that out there. Gold erupted higher here, guys. We are reaching new heights today. Today is another really, really good day for gold bulls. And I know that there are people out there who are, you know, when markets move like this, I said this to James just before I jumped on the show here. James is one of our producers, not the previous James that was on, but James, the producer. We were talking about just how, you know, periodically you have people who are really struggling coming in the chat. And if you're listening, I totally feel for you. I've been there many times. And I understand like how hard this stuff is, and you realize how hard it is. And it's pretty humbling, right? When these kinds of moves happen in the market, a lot of people lose a lot of money because they overestimate how markets are that difficult. They really are that difficult to make money in. That being said, what I've learned over my years of trading is you need to back test. You need to actually take the time to learn this stuff. And when you see somebody like myself or some of our other guests who are, you know, showing their you know, results or their years of work to get to the point, you're looking at somebody's blood, sweat, and tears, right? You're not looking at somebody's like, oh yeah, I just threw an account together and started throwing directional trades. Like, oh yeah, I think gold's going to go down. Oh yeah, I think so. No, like professional trading is like a 4+ year degree. It is so difficult to get to that point. And the reason I harp on that message so frequently is because I think people need to hear it. Social media is so full of people telling you how easy trading is when it is in fact like one of the hardest things, if not the hardest thing that I've ever done in my life. It is so hard to consistently make money overall in the markets. And drawdowns are incredibly painful. So it's not easy. There are easier ways to make money, trust me. Like, if you're somebody who is like, it's just the learning curve is so much bigger than people think. It was so much bigger than I thought, that's for sure. Anyways, everything is moving like crazy this morning. We were up, 1.3% on the NASDAQ. It ripped to highs, or not to highs, but to today's intraday high. The S&P 500 reached an all-time intraday high. It's giving back some of that, but if it were to close right now, that's an all-time closing high right there. And look at the Dow Jones, guys. This is actually really impressive. We're actually seeing value, SPYV. Value is up 0.5%. SPYG. Is this growth? Yep, growth. Growth's up slightly more. Okay. Anyways, the Dow Jones is killing it today, breaking through the highs. I like this one on a pullback. Now that we've broken this level of resistance, we're confidently above the 40,000 mark on US 30. That is the Dow Jones Industrial. Really crazy. Really crazy. Is using TradingView replay okay for backtesting? It is, but I think, backtesting with the right platform is really, really important. I have mentioned and partnered many times with Forex Tester. I think they have a new product that is coming out that I've got video details coming on soon, but I can't speak too much on that, but it's really exciting. And, backtesting is what you make out of it. A lot of people cheat their backtesting, right? They don't spend the time, they don't spend hours and hours. And I think it's really necessary. If you don't know anything about backtesting and you're like, what is backtesting? It's basically going back in historical price action and studying your strategy, like practicing your trading, basically. It's like trying to just show up to a basketball game and play like a hero when you've never gone to a practice, right? Like if I went to a basketball game and tried to play basketball in front of a bunch of people, it would be the funniest thing you ever saw because I would look like such an idiot. But if I went to practice, I would still look like an idiot, but I'd look like slightly less of an idiot. That's very comparable to trading. You go to practice a lot and still look slightly less dumb, but still it's hard. So gold is pushing higher. It's definitely a monster mover for me. And July is actually shaping up right now. We're at the halfway point of July. I think I'm up 4% in my account, which is pretty good for me. I know for people who go for more, you go for more. For me, a 4% month is like really big for me because usually I'm shooting for like 2% as an average. Like 2% is a good month. 4% is an excellent month. So I've had I've had a good streak. And most of it has been off the idea that I have kind of been vocal about my thoughts on, I think rate cuts are coming down the pipeline this year. I've mentioned that because, in my positioning as well, right? I'm long technology, XLK, which is the biggest current winner on the account. Gold, GLD. So I'm long gold. That's the second biggest. And I also have silver, a little small position on silver, which is not small, but proportionally it's smaller than my gold trade and XLK trade. And then I have TLT. So TLT is a bond ETF. So I have a couple different trades going right now, and I will be real with you guys. Like as a content creator, I want to take new trades. I want to be more exciting than simply just saying, oh yeah, I got these big winners, I keep running. But like genuinely as like a trader, here's my thing. My goal is obviously to like make the most amount of money I can with taking the least amount of risk possible. So from a trader's perspective, I can say genuinely, like The actual thing I'm supposed to do right now is absolutely nothing. But I'm telling you candidly, like as a content creator, I want to take new trades. I'm taking trades as dangerous. This is dangerous about being a content creator in the trading space. I want to take trades because it's more exciting for content, right? But there's nothing I can do, right? Like I know at the end of the day, my number one goal here is to make money. Trading is, a way that I make money. It is, so that's the thing is I'm like, I have these pressures where I'm like, I want to trade for content. I want to trade for, but sometimes really the best thing you can do is trade nothing. And I know it sounds like, well, it's easy when you have good trades running, but even if I had no trades on sometimes, and this is the most frustrating time, is when I have no trades, but I also know I'm not supposed to take any, right? And we'll do some, I'll show you what I mean by I know I'm not supposed to take any. I know my system. I've traded it for years, but yes. Questions about, these are always fun conversations. So wait, Nick, is 4% good monthly profit? I make 10 to 5% weekly. So is it possible to make 5 to 10% weekly consistently? In the long term, no, you'll blow your account. No one's ever done that for a consistent long period of time. 100% chance you will blow your account if you trade at that rate for too long. You might have a stretch where you make 5% a week and it's going well, but then when things go poorly, there will be times where I lose 4% per month. There will be times where I lose 5 or 6% in a month. I haven't had that in a minute, but I know it's coming and I know it's going to suck, but it's what you accept. Will you cover Uncle Jay's speech? Yes. Speech is in 30 minutes, guys. James informed me that they moved the speech back, but we will prep for it. We'll talk a little bit about it and see what he has to say. So, if you look at the math of returns, pretty, it's not even controversial to say that the more you go for, the higher your drawdowns inevitably will be. In the markets, there's no free money, and the more reward you're going for, the greater risk you take on. And if you get lucky for a period of time and you have really huge results, but you don't have any drawdown, if you keep doing it, something will change. Markets just change over time. I'll give you a quick example. This year, if your strategy has been, I leverage and I buy the NASDAQ with a big lot size every time it dips 1 to 2%, this year, you would think that you are a market god, right? And you'd say, well, look, my drawdown's not been bad and I make 5% a week and it's been so easy. But 2022 would blow your account. Do you see what I'm saying? There is it in a nutshell. The environment that you're in can be very deceiving. If you're in the right environment, you can make a ton of money with particular strategies. If your strategy was to trade range bound on the NASDAQ, you've gotten killed. If you've been shorting the NASDAQ, you've been getting killed. But shorting the NASDAQ over here would have been genius, right? So my point is, every strategy has weaknesses. Every strategy has drawdowns. If you risk too much in a good time and believe that it will continue like that, when conditions change, you'll blow your account. So anyways, I don't go for huge returns, but I'm also like very privileged to have a larger capital basis. I don't need to make big returns percentage wise in order to do decently well with like the P&L. So, and that's a huge advantage. Trading a bigger account, you don't feel pressured to make big percentage gains. Big percentage gains is what leads, like the temptation to go for bigger percentage is what leaves people ultimately blowing their account. And again, the biggest deceiving thing that I always rant about with the NASDAQ is like people get used to what they're in. They get used to it going up or they get used to it going down. And when it changes, things get, a lot more hard. So right now we're in a bull market and I do very well in a bull market myself. My strategies typically do really well in bull markets, which is why my performance has been really good this year. We're in a bull market. But I'm conscious enough that I know that when things change, And gold and NASDAQ aren't trending up. I mean, gold has been a big winner for me, but it's also been a really nice bull market for gold too. So I'm not thick-headed enough. I am thick-headed, but I'm not thick-headed enough to think that this is going to continue forever. I know that I'm in the right environment. I'm making money on this stuff while I can, but I understand that something will change, something will break, something will turn these markets around. But I don't know when that is. And for me, it just means make hay when the sun is shining, as my dad always said. So make hay when the sun is shining and trail stops and be prudent, but don't get arrogant, because I got arrogant in 2021 and it cost me huge in 2022. I'm in a really good stretch in my trading. Like I am making more in my trading than I ever have before right now. But in 2021, I was also making more than I ever had before. And in 2022, I got absolutely crushed on camera. It was bad. I got destroyed. My percentage drawdown was like 35%. I shared it on YouTube, and it was a really tough psychological time for me. But I stuck to the plan, and things have rebounded. But my gosh, it's like I lost like a kidney during that time. It was so painful. And it's probably going to come back. So since that time in 2022, I really, really made a decision in my trading that I think 2022 was such a lesson for me, because during this time, I had a very significant drawdown because, again, as I mentioned, I typically do better in bull markets. I typically am more on the bullish side of sectors, ETFs, stocks, indices, which is what I trade a lot of, and gold. And everything dropped in 2022. Bonds, gold, stocks, everything dropped. And it was really, really hard for me to catch anything that was moving. I was short a little bit, but my shorts were small and they weren't covering the false starts that we would have where I'd be looking for breakouts, and, just nothing was working. So that's my learned lesson when in 2022 was, after that happened, after I went through that drawdown period, and I said, look, psychologically, as a human being, I have to talk about this stuff on camera every single day. And as you could probably imagine, getting on camera when you're going through a really bad drawdown is maybe one of the most difficult things ever, because it's not fun. People are like challenging your abilities and like whether or not. So that time was really tough for me, but I made a decision during that time. I was like, you know what, going forward, I am not going for max gains. I'm going for minimum drawdown, 110%. I care more about my drawdowns than I care about my gains. And what I've found since then is my trading has gotten so much better, because now that I pay ultimate attention to my drawdowns, the gains take care of themselves. That's been the lesson here is, once you start taking care of your risk sizing and everything else kind of falls into place. So there's my thought process on it. That's my hard learned lessons. I've done this for a number of years. I've seen up markets, down markets, and I can tell you that when something is working very, very well for you, just be skeptical. Skepticism pays well in trading. Be skeptical when something is going really, really well. Not necessarily change what you're doing, but understand that if you're risking too much and you're getting too greedy and you're getting too optimistic, things will change, strategies will break. You have to be able to handle the drawdowns until the good times come back again. Hopefully that was helpful to you. I just had a full rant. So let's now take a look at some charts. Sorry for the rant of people who are like, I just want to see some ideas, Nick. I also wanted to mention that if you guys are looking for access to our VIP room, I mentioned this earlier, we're doing a really big discount this week off of our monthly memberships. If you'd like to trade alongside me and my team, we're currently doing 40% off of our VIP memberships. But while we are speaking here live, if you guys would like to join us in the action, we're going to do 45% off for people watching with us right now. So we'll do 45% off our monthly memberships, 30-day access for like not a lot of money. I don't know what the price is off the top of my head, but if you'd like some details, you can speak directly with someone on my team right here. Just direct message us there. You get 45% off. You get access to every trade we take, swing trades, shorter term trades, position trades, everything that I am doing in the markets, as well as Frank and Ivan sharing his as well. We do coaching webinars in there. We have a chat room available. So if you're thinking about getting access to it, now's a great time to try it for 30 days for 45% off. So yeah, and just staying on the transparency train here for a second. Our goal with this is we want to get more people to come join us in the Discord, try us out for 30 days, just so you can see it's worth the money. And then we hope that you'll stay longer term. Nick, if you're making so much money, why is the Edge Finder so expensive? What's up, Rick? Good to see you, man. And Rick, I gotta say, you've been critical but also supportive on my channel. I've seen your comments for like months now, so it's good to have you in the chat. But why is the Edge Finder so expensive? That's actually a really good question, and something I've learned more about over time in the software world. So I went to school for software engineering, and when you see a company like Google or Microsoft or these ginormous tech companies selling a product, what you'll notice is that their prices are like way lower. But it's because they have like the economies of scale that a small business does not nearly have. They have such a huge platform to sell something that they usually will charge much lower prices. The Edge Finder is an expensive tool because it's an incredibly expensive product to develop and maintain. We have several, full-time people involved behind this product that make it possible. It's the curation of Frank and I's work over years and years of studying the markets, but more importantly, we have a ton of stuff that goes into this. I mean, here's just an example, just while we're on the subject, if this loads here. Let me see. Is this right? Am I in the wrong place? Anyways, we have all these different data logs and things that are pulling and accumulating data, and these things break, and we have to fix them, and we have to repair them. We have to add new features. There is so much time and effort that goes into this product, and there's nothing else really like it. So the reason the Edge Finder is the price is the way it is because it's not a cheap platform. It's a premium one. So if you're very serious about your trading, you want to get into fundamentals, yeah, the Edge Finder is not your cheapest option, and we will never be the cheapest option. We will always be on the premium side because you get what you pay for in this stuff, and we offer a really great tool. And we have a lot of people who use the tool and love it at the price that it's at. So we're not going to lower the price. So we do offer discounts on it. And if you're somebody who's thinking about getting the Edge Finder, I'll just let you into a secret so you can have time to prep. We're going to be dropping the price big time for a week next week. So we do have discounts that we do frequently. Next week is your shot on the Edge Finder. If you'd like some information about that, we'll just drop the link now in the chat so you can speak with someone on our team who can keep you up to date. If you'd like some updates on that, just let them know that you're looking for the Edge Finder discount, and we can get you set up. So we'll drop the link to the live chat center. Okay, yeah, so there's your update. And so with gold, I did trail my stop a little bit tighter on this off the 4-hour chart. So price broke through resistance here, found support again, found support. So I've got my stop loss just below this 23.90 level, and things are just flying higher here. We do have Jerome Powell speaking in the next 20 minutes. So we'll see what that brings. Anytime Powell's speaking, it can be very volatile, as you know. How do you feel about dollar yen? Yeah, let's have a look. USD JPY. Okay, so dollar yen. I'm so curious about what dollar yen chooses to do at this support level, because this is a really key level of support. But where I'm hesitant about this is the dollar weakness might not be over. So I'm kind of conflicted on this, because when we look at the dollar, I'm sort of bearish dollar, but when we look at the yen, I'm also bearish yen. So I really don't have like a setup on this one. If I talk briefly about any yen setups that I can see, Euro yen is the closest one to a setup that I might like, which like Euro yen on the bullish side. Yeah, I kind of like Euro yen. If it pulls back, that's a 50% retracement. Actually, no, it's a 61.8. So I do sort of like this setup. If we get Edge Finder confirmation, support level gets hit, I like that trade. On yen crosses, That is, that's what I'm looking for. I hate Euro USD. What's going on with the Euro today? Euro, this is one that I like the upside for the Euro dollar if it can break resistance here. This is another one. I've just got so many things like this right now, and I've talked about this a lot, so I won't rant on it. But there's just a lot of things that are moving really strongly right now, but not giving a lot of pullback setups. So I'm looking for something like this. What are the strategies you use in the Discord? The strategies used in Discord are what I talk about on my videos and live streams, and as well as, Frank and I have been trading together for a long time. We use a combination of technical analysis, mostly the 4-hour chart, 1-hour chart, and daily chart levels. And we mostly use fundamental analysis to guide which direction we want to be in, and simple technicals to set up trades. So within the group, I'll just show you, if you're somebody who is thinking about it, I'll just show it to you for a second. So we trade indices, we trade commodities, FX, stocks, and ETFs, and you can see Frank's trades and Ivan's trades, who trades primarily Forex. So if we go to like commodities for a second, so the gold trade is in here. Well, let me bring that back up. The gold trade in here. So the full breakdowns with simple technical charts, as well as, more importantly, like the fundamental analysis, right? Jobs data and PMI data, we traded the reaction there. So that's pretty much what it's about. It's every trade that I am taking and showing on my YouTube channel, when I take the positions, they get shared inside of the Discord. So again, if that is something you are interested in, we'll drop the link one more time. We're doing 45% off, like I mentioned, for the monthly memberships. It's 40% off, but for stream viewers right now, we're doing 45. So click the link, chat with us right now, and get involved. How can you join the Discord? Like I said, just chat is right there. When you click that link, you'll be taken to a conversation spot with voice crack, a conversation with someone on my team who can help you out. All right, let's keep pushing on. We're about 15 minutes away from Powell speaking. NASDAQ up 0.5%, S&P up 0.5%, and the Dow Jones actually leading today, which is interesting. I mean, leading of the main three, but really what's leading is the Russell. The Russell is breaking out big time. Let's look at this on a weekly chart just really quick. So for those of you guys who don't know or trade the Russell, it's something that I really like to watch. I talk about the Russell a lot. Most people, when they talk about indices, they talk about the S&P, they talk about the NASDAQ, they talk about the Dow. But the Russell 2000 index is small cap and mid cap companies in the United States. So these aren't your Apples and your Googles, but they're, your much smaller companies that make up a very large portion of the U.S. economy, and the average kind of business at home, if you will. So they matter a lot. And I watch the Russell a lot because while the S&P 500 has ripped to all-time highs, the Russell has really lagged. And I think that there is room. I know Chris Pulver is on this trade, and so is Frank. They're both long the Russell, and shout out to them. Shout out to Frank and Chris, because they've got the Russell. I'm watching the ship sail away, but I do like the Russell. It does look like we are set to get some rate cuts this year that could stimulate the economy, could keep growth in line, and the Russell may finally see some solid earnings growth finally. But we'll see. That's a lot of speculation. Now, let me follow that up. The theory, the hope is that we see interest rates come down. I mean, let's quickly, we're going to do some data diving here for a moment. So give me a second, I'll set this up. So let's go first to JOLTS jobs. So I've been given this speech many times, so bear with me here, but I'll try and keep it quick. If we take a look at job openings in the United States, they are consistently coming down. Now, before you get all, well, haha, now we're Jobs data is crashing. It's not crashing. Jobs data is actually at a pretty decent long-term perspective spot. I mean, this is where we were 2019. So this is like pre-pandemic zone. We jumped up. We dropped off a cliff when COVID set on, and then we saw massive job growth, obviously because we had the pandemic, and then people got their jobs back. So we had like rehiring, which caused a huge surge. That huge surge and all the money printing also led to huge levels of inflation. So we're finally seeing the job openings decline, but it's not like it's at like a horrible level. I would say you'd really get scared if you saw job openings kind of break this, right? So we are seeing jobs cool in the United States, but we're not seeing them crash. Now, if this accelerates, then you've got something different here. If you got something a little bit more perhaps sinister than just cooling in the jobs data. Unemployment rate is also trending higher. We could go back a few years, take a look at this together. So where's unemployment rate at? Unemployment rate was very, very low pre-pandemic. It shot up during the pandemic as everyone, obviously, the economy shut down, jobs got cut across the board. And then we have recovered since then. And now we are still at very, very nice low unemployment rate. However, the recent trend has started to see an uptick in unemployment rate. This is why I think the Fed will cut rates this year. We have labor data, which is showing now, okay, unemployment rate is rising. We're not at critical levels. It's not like, oh, the whole world's unemployed or anything like that. Like we're not seeing, COVID or anywhere near it. These are record low levels of unemployment. We see good jobs data out of the United States overall, but it's starting to crack. It's starting to show signs of reversing course a little bit. So let's keep going. Stay with me here. So if we go to inflation data and we say, okay, look, inflation pre-pandemic was very low. In fact, don't we all miss the days where inflation was terrible? I'm sorry. No, we don't miss those. We are living in those. So pre-pandemic inflation was not bad. It was not bad. We were around targets. This is what the Fed wants. They want to see like 2% inflation. We skyrocketed after the pandemic, and a lot of people will take that as an opportunity to get political and say, oh, well, this is so-and-so's fault and whatever. The pandemic was thrown in the laps of both, of our previous presidents. And it's kind of tough to say who's really at fault. That's up for debate. But what's not up for debate is that all of us saw huge spikes in inflation, but we've now seen some progress. We're still above pre-pandemic levels in inflation, but recently we've started to see some progress again, and that's good news. I mean, who's not cheering for the grocery store to stop kicking our butt once a week, right? So we're seeing some progress in inflation again, which is good news. And let's hope that that continues, because that also suggests rate cuts might be on the table. So that's why I think rate cuts are potentially coming back into the picture. Now, what about growth? This is another one. Let's take a look at growth. Growth in the United States has cooled significantly. Now, that was a necessary thing to happen, according to most economists. And I'm not an economist, but my thought too, and most people's thought, is you're not going to get inflation to finally come down unless the growth of the economy slows down a little bit. Why? Because when people are getting paid a lot of money and growth is really strong, people go buy houses and cars and they travel and they spend money on goods, and that leads to inflation, right? When everybody's buying products, the prices go up. Like, think if you were a store and tons of people are lining your door every day, you're going to raise prices because you're like, why not? Why wouldn't I raise prices? Everybody wants my stuff so bad. It's kind of the same thing on an overall picture for the economy. So I know we're deep diving into data for a second, but there is a tunnel light at the end of the tunnel here after we get done with this. So the point is, growth is slowing, but not crashing. Data is rolling in for jobs that is showing signs that we may start to see unemployment rate rising a little bit. So my point with all of that is the Fed now seems to be very much tuned into lining it up. I've heard people say teeing up a rate cut, right? Seems like Powell. So today, all that to say, when we hear from Jerome Powell in just a few minutes, what people are going to be looking for primarily is confirmation of what I just said. Is the Fed kind of positioning dovishness for a rate cut? That is the question. Rate cuts in September. And Frank pointed out to me that there actually seems to be in the Fed Watch tool, maybe even 3 rate cuts possible this year. So interesting. I kind of lean towards like 1 or 2. I'm not overly optimistic about 3, but my point is I've been on the camp of I think rate cuts are coming this year for a minute now, and that's led me to being long gold, long silver, long TLT, and long technology. Now, last thought about the Russell, right? Nick, why aren't you long the Russell? You tell me. I wish I was, because my gosh, I'm missing out. But why I've chosen to stick with what has been working, which is the XLK trade that I'm in. The reason I am so kind of sticky with hanging on to XLK, which, by the way, what is XLK? You guys ready? Here we go. Finviz.com. XLK is this. XLK is this. This is the technology sector. So by buying XLK, I have access to Microsoft, Apple, NVIDIA, Broadcom, Adobe, Oracle, Palo Alto, CrowdStrike, ServiceNow, Salesforce, Intuit, AMD, Texas Instruments, Intel, Qualcomm. Long story short, it's the technology sector. And as frustrating as this has been for most of the other stocks in the S&P 500, technology has been the dominant player this year. So if we go to a 1-year performance, look how green technology is relative to the others. Technology has been the winner, and I'm staying with the winner. I'm choosing to stay with the winner. Why is that? Because what we're speculating is that growth is not going to continue to slow down in the US, that we're not going to see a recession, that's what we're speculating. And that speculation is why the Russell is jumping up so much. Inflation's coming down, but growth is going to hang in there. But for me, the NASDAQ with the XLK technology, we benefit from rate cuts, but we also know currently that these companies have tons of earnings, like Apple's, and well, Apple's not particularly impressive in terms of how much they make, but their revenue growth has not been super impressive. But look at your NVIDIAs and your Metas and these companies that are just killing it in terms of beating estimations. Now we're coming into earnings season. So long story short, I think they cut interest rates this year. I don't know what happens with growth. If inflation doesn't continue to come down soon, growth could really get hurt. But there's that question of, are we going to thread the needle where inflation comes down without growth crashing, and then we can cut interest rates and growth stays strong? If that happens, Russell is the place to be, right? Because Russell is like the sensitive but very superpower potential candidate here. If you get good inflation data and growth that stays strong, the Russell will be a monster performer, like it was the end of 2023. It was up like 30% in a couple of weeks. So yeah, XOK and S&P make the exact same moves. Directionally, they may do that, but here's the difference. If you take a look at SPX 500, and let's actually do this, I'll show you. Do they trade directionally the same direction? Most of the time, yes, because the tech sector makes up a good weight of the S&P 500. But here is the difference. If you take a look at year to date, if you had bought XLK, you're up 25%. And if you bought the S&P 500, you're up about 20%. So there is a difference there. It's not massive, but I'll show you what is massive. If you had bought let me see if I can give you another example. What if you bought the Dow Jones? So if I bought the Dow Jones, look at the difference between tech and the Dow Jones, which is another index that a lot of people buy and hold, right? So if you bought tech, you outperformed a lot. So my point is, buying XOK, is it directionally biased or directionally correlated to the S&P 500? Yes. Yes, it is. But the magnitude is the difference, right? And same thing to the downside. If I'm looking at SPY and you're saying, do you want to buy SPY or do you want to buy, something like XLK, which is tech, the tech companies? Well, to the downside, what would probably happen would be the opposite. XLK would drop harder than the S&P 500 in theory. In theory. So yeah, that's kind of what I wanted to point out. If you're a fundamental trader, you're probably an international economist. See, that's the thing. I don't really think of myself as like an economist, although I look at a lot of economic data. I think trading is a like, if you're a fundamental trader, do you use economist like theory? You do, but you apply it, right? That's kind of the difference. A lot of times, like, economists are very like theoretical, and if you do pass these sorts of bills, what will it do here? And I don't really get into like prediction of that. I kind of look at what's the story and like what trends are happening, so I can actually trade it. That's why I kind of reject the idea. Like, I'm not an economist. I'm a trader. There is a difference. Powell's speech coming up. Yep. So we got a few minutes to wait. We have it pulled up for you guys. Don't worry. Producers are on that. They're on their A game today. We're on a 4-hour stream. This is part 2 of my contributions. We had several other guests come on today. So good stuff on the producer team today. They did an awesome job. I mentioned this earlier. If you guys would like to trade alongside us, any trades that we take inside of the VIP room are currently 40% off. But for stream viewers, during this live stream, you get 45% off. We dropped the link earlier. We'll drop it one more time. If you guys want to get access to the trade alerts being shared, hit that link. It's in the chat right now for you. You come join in the action. The thing I always mention is, like, if you're going to join our group, out of respect for people who are thinking about getting it, I show you guys my real account for it's not always fun to do so. When I'm in a losing streak, it's really painful, but I show you guys my live brokerage account all the time for the purpose of transparency. And because we sell a service, I like to try and offer, you're watching real stuff. You're not, because there's a lot of services out there, a lot of people who sell stuff, and they never show you that they're actually trading a real account. And to me, that is not cool. So if you would like to join into our room, that is 45% off. Come join us. It is worth the money. I'd like more videos on PD arrays explained in detail. I have no idea what that is, and I have never needed it personally. So I'm not sure what that is. If that's like a technical pattern or something, I could tell you that the results that I've had over the years in my trading, both ups and downs, have not come from fancy technical analysis. It's fundamentals. One man, but yeah, I love this. One Punch Man. Good afternoon. I've seen that meme 74 times. He like walks up to the mic. It's like an edit of Jerome Powell. He walks up to the mic. He like taps. He says, "Good afternoon," and then the market crashes. It's a great one. Yep. So stand by. We're waiting just to hear from Powell here. We'll see what he has to say. Oh, PD array is a ICT concepts thing. Nothing against ICT concepts or people who use it, but I personally don't need anything past really, really simple technicals. Like what you see on my screen, that's all my hidden secrets. I just have support zones and resistance zones. And if I get really in the technical mood, I might draw a Fibonacci retracement. Crazy. No, but I think that I say this very frequently, so I apologize for repeating myself, but um, generally speaking, I think technicals are a trap for a lot of traders. A lot of people overcomplicate technicals. They get super fancy with it and they say, oh, I don't need fundamentals. But then, like, so many, if here's one thing you have to ask yourself: if you think fundamentals don't matter, why is it that when they interview hedge fund managers and huge successful finance moguls, why are they all talking about what the Fed is going to do, and why are they talking about the economic data that's been coming out? You have to ask yourself, just think for a moment, why are all the most successful people in the financial markets talking about fundamentals? Right? Have you ever thought about trading with or making your own prop firm or hedge fund? No. Well, I have. I have before. I've even talked to my wife about that. I was like, do I want to go down the route of managing money? Because admittedly, I would probably make a lot of money, right? It's an incredibly lucrative venture to like start a fund and manage people's money. But what I realize is I don't I don't want that kind of stress. Right? I don't want to manage people's money. I don't want the losing streaks for myself are hard enough. I don't want people calling me, telling me, hey, why are we in a drawdown? So this is the comment of the day. Larry Fink taught me fair value gaps. Larry Fink is the BlackRock CEO. And I am pretty confident that he's not looking at fair value gaps. One of the most powerful CEOs on the planet, really, because BlackRock owns like everything else, right? They are even buying up houses in neighborhoods, I'm pretty sure. So like, yeah, that's crazy. But yeah, if you listen to Larry Fink, if you listen to Ray Dalio, if you listen to, heck, a lot of different successful money managers that go on, television or they get interviewed, they are always talking about the macro data. They're talking about company financials if they're talking about a stock. Like they're not. That being said, I'm not saying technicals are useless, because I've also heard many professional, money managers and traders talk about like, oh, it's building momentum. The moving averages look good. We've had a breakout, but it's like, if you just look at the best in class, like if you're trying to be a professional basketball player, then you watch and you learn professional basketball players, what they do, what they speak about, what they tell you about. Like that's who you got to learn from. Why is it in trading, people just go watch like some social marketing guru that has like a fancy car tell them like, buy my course? Like, why is that? Why don't people listen to, and people do listen to, but why isn't it more commonplace to go listen to fund managers and people who like have serious credibility? Those people get like overlooked and people just instead go for like social media BS, right? It's weird to me. But if you listen to those people, what you'll find is that their technicals are like simple enough that without seeing a chart, you can understand what they're talking about. Like I was listening to somebody talking about some stock, and they were pointing out like, oh, it's put in higher lows and higher highs the last few months. We've broken out on like the 200-day moving average. And I was like, I don't even have to see that chart. I know that chart looks pretty good, and they're buying on a pullback, and that's all they needed for technicals. Then they went into like the company's story and what had changed in their earnings reports and their projections. And I was like, yeah, that's I resonate so much more with that. And I that really changed a lot for me personally when in my own trading, is like learn from the real professionals, not the social media, fake stuff. They're always late for Powell's speech. Yeah, we're just waiting on his speech. Nothing yet. We're standing by. We're on the same wavelength. Fundamentals give you the direction. Technicals give you the entries. Yes. That's a good point. Sasha says, Well, I think it's because in social media, they want to sell something, and big CEOs don't care about something like that. The thing is, a lot of these guys do actually have something to sell. Like hedge fund managers want people to invest with them so that they can get a piece of your return, right? If you give a manager a bunch of your money and they make gains on it, they get a piece of it. They also have management fees. So there is something that they have for sale. But yeah, it's I think it's less about trying to sell people like the dream, the idea of getting rich, which is an incredibly good marketing strategy. Come on, let's be real. Everybody wants to get rich without doing any work. Nick will watch Powell here. Yes. Just stay in. We'll have it pulled up in a moment, guys. He hasn't started speaking. We're just standing by. The James has got it on lock for us. We're keeping an eye on it. What's the edge you get on support and resistance levels, and why does that work so strongly for you? The edge is not using just the chart to make the decisions, right? It's about using the fundamentals. The real data is why, that's the thing is, like, for me, people ask, like, how do I know it's not a false breakout? You don't. But with a good understanding of the underlying story behind the market, the fundamentals, right? The economic data, the company financials, whatever you're looking at, right? The good understanding of that, with a higher probability whether or not a support or resistance level will hold. It's not the way you draw your support. This is like mind breaking for me a couple of years ago when I really started to reach that like profitability stage. It was mind boggling to me. It's not about how you draw your support. It's not how you draw your trend lines. It's tying up support and resistance and trend lines and Fibonacci and all that simple stuff with a good understanding of why this market should or should not continue in a certain direction. All right, we got him speaking now, so we'll pull it up, guys, and we'll see what he has to say.
Tragic events in Pennsylvania. Some people wondered whether that would affect the markets today. Can you give us any insight as to whether you think it's had any impact on the markets?
David, I think I'll leave the markets out of it for a second, if I can, and just say that it was really a very sad day for our country. Political violence has no place in our society, and I condemn it in the strongest terms. I know we all do. A man died at a political rally. 2 other people were critically injured. It's just a sad day. And I'll say that I'm grateful that the injuries to the former president were not more serious. I'd rather not comment on the markets. It's too...
Okay. So let's get another answer that you don't want to give. There are a few billion people in the world who are waiting to see what interest rates are going to be doing. Do you have any insights on where interest rates might be going?
So I'm going to take that as a great opportunity to talk a little bit about the economy and then talk about where that leaves us with policy. So I would just start by saying that the U.S. economy has performed really remarkably well over the last couple of years. 2023, last year, was a year in which the economy grew well above 3%. The labor market remained very strong, unemployment remained very low, and inflation came down at quite a sharp pace, particularly in the second half of the year, by a very large amount. And that forecast was almost unheard of. It was unheard of before 2023. So big upside surprise that year. This year, we had expected the economy to slow a bit gradually, the labor market to continue to gradually cool off after being overheated a couple of years ago, and inflation to continue to make progress. And something like that is basically what has happened. The economy is growing now at about 1.5% in the first half of the year. Most forecasters have about a 2% growth rate for the full year. The labor market, again, has moved into better and better balance to the point where I think you can now say it's essentially no tighter than it was in 2019 before the pandemic. Remember that the labor market of 2019 was a very strong labor market. So we're back to that place, no longer overheated. On inflation, in the first quarter, we didn't make any more progress. The second quarter, actually, we did make some more progress. We've had now 3 better readings, and if you average them, that's a pretty good pace. So turning to policy, your question, what we've said is that we didn't think it would be appropriate to begin to loosen policy until we were we had greater confidence that inflation was moving sustainably down to 2%. We've been waiting on that, and I would say we didn't gain any additional confidence in the first quarter, but the 3 readings in the second quarter, including the one from last week, do add somewhat to confidence. We've also said that we're a dual mandate bank. For a long time since inflation arrived, it's been appropriate to focus mainly on inflation, but now that inflation has come down and the labor market has indeed cooled off, we're going to be looking at both mandates. They're in much better balance, and that means that if we were to see an unexpected weakening in the labor market, then that might also be a reason for reaction by us.
Okay, I think I understand. So to put it in terms I can for sure understand, the markets are suggesting, the futures markets, that there's a 90% chance that the Fed will lower its discount rate in September. Do you think the markets know what they're talking about?
So today I'm not going to be sending any signals one way or the other on any particular meeting. So just to ruin the fun right at the beginning.
Oh.
I simply, we're going to make these decisions meeting by meeting, and we're going to make them on the basis of the data as they come in, the evolving data, the evolving outlook, and also the balance of risks now that the 2 mandates are basically close to being in balance.
All right, there are some people who say that the Fed would not like to lower interest rates in a presidential campaign period because you could be criticized for helping one party or another. Do you have any comment on whether that's an accurate view?
I do. So our undertaking at all times is that we'll make our decisions based on the incoming data, the evolving outlook, balance of risks, and only on that. We don't take political considerations into account. We don't put up a political filter on our decisions. That would not, it's hard enough to make these decisions based on the appropriate factors. If you're going to add a whole different filter in an area where we're not experts, that's not going to improve the quality of our decisions. And it's also not the orders we have from Congress. Our orders from Congress are to use our tools to foster maximum employment and price stability, and to do so without political considerations. That's what we're always going to do. If you look at the modern record, that is what we do. And we don't think about election cycles or anything that's political.
Okay. So the Fed has set a target for inflation of 2%. Now, can you clarify, does that mean that the inflation rate has to be at 2% before you're ready to move, if you are ready to move, or does it have to be within sight? And what does it mean to be within sight?
So when we change interest rates, that tightens financial conditions, and that in turn affects economic outcomes, growth, labor markets, and ultimately inflation, but with lags that can be long and variable, as Milton Friedman famously said. And the implication of that is that if you wait until inflation gets all the way down to 2%, you've probably waited too long, because the tightening that you're doing, or the level of tightness that you have, is still having effects which will probably drive inflation below 2%. So we've been very clear that you wouldn't wait for inflation to get all the way down to 2%. Our test has been for the past quite some time that we wanted to have greater confidence that inflation was moving sustainably down toward our 2% target. And what increases that confidence in that is more good inflation data. And lately here, we have been getting some of that.
Okay. So when you say we, let's talk about who we is. The FOMC, for those who don't follow Washington acronyms, it stands for what? What is the FOMC?
It's the Federal Open Market Committee.
Okay. And who is on that committee?
It's a little bit complicated, our structure is. We have 7 governors here in Washington, all nominated by the president and confirmed to staggered 14-year terms. And we have 12 reserve bank presidents at reserve banks around the country. All 19, 7 plus 12, are participants on the FOMC. In any given year, all of the 7 governors vote, and 5 of the 12 reserve bank presidents vote. But one of the voters is always the New York Fed.
Okay. And so when you have an FOMC meeting, how many do you have a year?
We have 8 a year.
Okay. So you have 8 a year. And when you get together for 2 days or so?
We do. So generally starts at noon or in the morning of a Tuesday, and we go all day. We generally talk about the economy, the financial stability issues, whatever special topics there may be. And at the end of the day, each person speaks on those things, and I speak at the end of that day. Then there's a brief presentation on monetary policy, and then we go to dinner upstairs in the Martin Building, and we come back the next morning. We come in at 9 o'clock, and we talk about monetary policy until we're satisfied with the outcome on monetary policy, and that usually takes most of the morning.
Okay, so when you go into an FOMC meeting, that the first day, do you pretty much know where you want to come out at the end of the second day, or do you want to listen to everybody and you haven't made up your mind yet?
You know, the way it works is that, you know, I talk to the other 18 participants regularly, and I talk to all of them at least once in the 10 days before the meeting. And I'm thinking about this 3 or 4 weeks before the meeting. You know, what should we want to achieve? What data do we need to see? How do we want to change our communications? All those things. And so I talk to people, listen to them, and I try to put together an answer that has broad support on the committee. And so when we go into the committee on Tuesday morning, you know, I'm confident usually that I know where this is going to go. But, you know, things happen. We get data during the meeting sometimes, events happen. But largely you go in kind of knowing what the likely outcome is. And that's the design of it.
So normally, you know, if somebody calls somebody, you call all the other board members, FOMC members from time to time. When you call them, do you have a trouble getting your call returned, or you get you get a call right back, or do they take your call right away?
These calls are scheduled generally, and they go all day long. I have, like, the Friday before the meeting, I think I have 11 half-hour calls, and it's pretty, you know, we talk about the economy. We talk about very specific aspects of the economy, about our mandate, and then we talk about policy. So there's a lot to talk about. I take pretty careful notes, and people think, but by this point, they've read all of the preparatory materials probably twice. They've talked about it with their staffs. And so, you know, you get a really good sense of what people's thinking is. It's a very good process.
But you don't feel you have to have unanimity when you make a decision, right?
No, I always try to listen carefully to everybody. I find that if you do listen and understand people's points and try very hard to incorporate them into what we're doing, for most people, most of the time, that's going to be enough. People do dissent. That's completely fine. We actually have, given that we have 12 reserve banks with their own economic staff and people with different backgrounds on the board and among the reserve banks, we have a disparity of views at every meeting on every question. But people do. I mean, I think there's a you want to dissent on important things, and so people are perfectly able to dissent, and when they think that's appropriate, they do.
So a lot of people in Washington, government agencies, are very good at leaking things. You're not that good at that. Why doesn't the Fed leak more? Why don't you kind of leak a lot more about what you're going to do? You just don't leak that much.
I'm kind of proud of that, actually. We do take our obligations to confidentiality very, very seriously, and because we know, you know, how consequential it would be for someone at the Fed to be leaking. You know, we just our whole success depends on having the public's confidence that we're ethical and that we're working on behalf of all Americans and not on behalf of ourselves, and we're not leaking and that kind of thing. So we do have a culture. When we're working on for example, a regulatory matter or some, you know, matter involving one of the banks, it never leaks out of the Fed. So I am proud of that record.
Okay, so if you go back in history, when inflation began to arise after COVID, at some point people said, including you, that it was transitory. In hindsight, what do you think people missed about the nature of the inflation? Why was it more enduring than people initially thought?
So this is a question that people will be writing papers about and debating long after all of us are gone. And it's early to say. It's actually kind of soon to be answering it. But I think so. Here's my answer to that question. When inflation arrived in March of 2023, it was really coming out of the goods sector, and it was connected to really high demand for goods, and it was. And you know, the supply chains, global supply chains, which account for most manufactured goods, collapsed because of too much demand and because of COVID. And you know, and to us, that looked like a temporary, fleeting situation. We also lost several million people out of the labor force, so wages went way up as the economy really boomed when we reopened the economy. And we thought, you know, we were getting vaccines were coming in, and we thought that would fix itself too. Kids would go back to school. We essentially overestimated how quickly the economy would return to normal. These things finally did happen in 2023. but they didn't happen in 2021 or 2. And what we meant by transitory was that it would go away fairly quickly without the need for our intervention. You don't want to intervene with interest rates if something's going to go away quickly without us intervening, because monetary policy, as I mentioned, works with long and variable lag. So the lure is you look through things like a temporary oil shock. So that was the mistake, was that it actually didn't reverse itself. The problems with the supply side didn't reverse themselves until 2023, when they really did, when we got a big burst of employment, and also the supply chains were fixed.
So in hindsight, now knowing everything you now know, would you have done anything differently? Would you have had less quantitative easing? Would you have changed interest rates differently? What would you have done differently now knowing everything we now know?
It's almost unfair. Hindsight's always 20/20, right? We remember what we were doing in real time. We went from a really nice economy in December of 2019 to a global partial shutdown of the economy. And we were contemplating, there was no thought that vaccines were around the corner, the economy's closing down. We were looking at severe and perhaps prolonged downside risks. Literally people thinking and doing work on, are we going to have another depression? Is it going to be the 1930s? So governments around the world, and in particular the United States government, really went to work to provide a lot of support to the economy. We did everything we could, including many things that were red lines that we'd never crossed. We crossed them to support the economy and support the financial system. And it was all done because we were managing severe downside risks, which did not materialize. We did not have a depression. And part of that is because of what we did. Then the economy reopens, and demand is very, very strong. And we saw a big burst of inflation everywhere, including in the United States. It was different in different places, but so that's what happened. And it's not. That's how I would answer that.
Okay, but so what you did, you're happy with what you did in hindsight, you would say?
In foresight, I think that the work that we did in 2020 in response to the pandemic will stand up very well in history. I think people will look at the things that we did, and essentially the financial system was grinding to a halt all around the world. We acted. We were the first central bank, and we were the most supportive. And I think that work will hold together when historians are looking back on it a long time. I think when you get to the inflation era, that becomes a different question, and people are going to be arguing about that for a long time.
As a result of the action you took, and the economy was thought to slow down a fair bit, and many people use the phrase hard landing to describe, hard landing is a euphemism for a recession, I guess. People thought in 2023 we might have a hard landing. People thought in 2024 we might have a hard landing. And none of these people were economists, professionally trained economists, but they seem to be wrong. So do you rely on these economists very much in the future when you're projecting whether you should listen to their views on where the economy is going, or how do you react to the fact that we haven't had a hard landing and disappointed all those economists?
So I'll just say that as someone famously said, predictions are very difficult, especially about the future. Right. And also, I know a lot of economic forecasters, and forecasters are a humble lot with much to be humble about. It is extremely difficult. Every good forecaster will tell you that it's very, very hard to know what the economy is going to do. I'll give you a good example. In our teal book, every FOMC cycle, there's a book that goes out, and there's a baseline forecast in that. And our forecasters are really the top people in the field, and they give you that baseline. They also give you a section in that book which shows 7 or 8 alternative scenarios, which they also regard as plausible. So it's always a probability thing like that. It's not we've identified this one thing. So as to last year was a big surprise, and it was a big upside surprise. So of course we welcome those. We'd be happy to have more of those. But it just was one of those things where where things turned out much better for a whole variety of reasons. I will say that on the hard landing question, I have always felt like that there was a pathway to getting inflation back down to our 2% goal on a sustainable basis without the kind of pain in the labor market, the kind of high unemployment that has been typical of tightening cycles and getting inflation down. And the reason why my colleagues and I thought that was that the labor market was so overheated that it could cool down quite a bit without having to, there still is apparently no slack in the labor market. The labor market does not have slack. Essentially, you're at equilibrium now. But look where inflation is. Inflation's at 2.5%. So this was in defiance of a lot of conventional wisdom, but we thought that was right. And that says that, you have to be, one thing you learn is humility in forecasting, but so I wouldn't rule it out, but I would say that the kind of hard landing scenario is certainly not the most likely or a likely scenario.
So you have said you have a target of 2% inflation. You want to get it in sight of 2%. Do you have a similar target for unemployment? If unemployment went to 4%, are you saying, well, that's okay because we don't need to do anything because 4% is tolerable? Or do you have such a similar kind of target as you do with inflation?
So you can't reduce unemployment to a single number because for a couple reasons. First of all, the natural rate of unemployment probably moves through the cycle and over time. Maximum employment is a function of many, many different variables. It doesn't reduce itself to a specific number that would be durable over time. So inflation has 2% inflation some years ago became the global standard that everyone aims for in one way or another.
Some people have suggested that the Fed's independence is not as good as people talk about it being, and that maybe we better have more White House coordination with the Fed. I'm sure you've heard about this.
I think that...
Any comments on that?
I'd be happy to comment on what independence, on the point of central bank independence. So I think a long time ago, people have learned that a central bank that's independent of political consideration does a better job getting inflation under control. And that is accepted wisdom in all advanced economies around the world. It's also a principle that has very, very strong and broad support where it really matters, which is in Congress. You talk to senior leaders in both chambers, in both political parties, and they all understand that you want an independent central bank that doesn't run monetary policy to support or oppose any particular politician or political party.
Independence is one thing, but you still have some information sharing. So how do you coordinate or share information with the administration? Do you regularly meet with the Secretary of Treasury or White House staff people, or how do you communicate with them?
So there's a very standard set of relationships which doesn't change at all, administration to administration, and I could start anywhere, but Council of Economic Advisors is in the White House. We have lunch with them every month or so, although they get canceled sometimes because we're all busy. That's one thing. I have breakfast with the Secretary of the Treasury every week, unless she's traveling or I'm traveling. I have, since there was a National Economic Council, there's been a regular / sometimes irregular breakfast with the head of the NEC, and I do that too.
Do you ever get a call from the President of the United States saying interest rates are too high or something like that?
So, ever? No, I would say that meetings with the president are rare and appropriately so.
Okay. So you were originally appointed to the board of the Fed by President Obama,
yes.
And you're appointed chair by President Trump and reappointed by President Biden. And your term as chair goes through, I think, May of 2026.
That's right.
So any thought about staying through all the way through May 2026? You're going to do that?
Yes.
Okay. And if some president came along and said, well, you did a great job, I'd like you to reappoint you, would you consider that?
I have nothing for you on that today.
Okay. All right. And is being chair of the Fed a enjoyable job or not so much?
It is, actually. I think I enjoy it. I enjoy it quite a bit. I do. First of all, it's a great honor. It's incredibly interesting. I love the people we work with. I love the institution. At this time in my life, it's just been a great thing. I'm in my 13th year there now, and it's been really challenging and all that. But what else would you want? I'm very happy doing the job.
So you're obviously in pretty good shape. How do you stay in shape? Do you walk a lot, or you ride bikes, or what do you do?
Yes, I do. I do those things. I swim, I ride my bike, I go to the gym a lot. I try to stay fit, as you'll remember from our days together.
Right. So but when you were, let's say, riding a bike, do
How's
people
it, Chad?
get out of the way, or do you have,
Seeing you lifting weights.
Nobody knows you with a bike helmet and goggles on. You're just another person on the road.
so I think you have said somewhere that when the Fed does lower interest rates, not saying that you're saying it's going to do that, but if the Fed does lower interest rates at some point, you didn't think it was ever going to go back to kind of the free money practically of years ago when interest rates are almost zero. Is that a fair statement, that you don't think it's a good idea to go back to interest rates as low as they once were?
The period between the global financial crisis and the pandemic was historically unusual from the standpoint that we had ever lower interest rates through that era, including a part of the era when, for example, sovereign debt of major European sovereigns was trading at a significantly negative rate. And so that was quite unusual. And still, even with rates that low, inflation was very low, below target. So the question is what caused that, and are the forces that caused that gone for now? And I think most people attribute the low inflation era to slow-moving forces like demographics, globalization, technological evolution, things like that. And those may or may not have changed. But nonetheless, I look at where we are now. Our funds rate is 5.3%, roughly, give or take. And it feels like it's restrictive, but not severely restrictive. So it tells me that rates, at least for now, the neutral rate must have risen, probably has risen from where it was during the inter-crisis period. And I mean, I think instinctively, I can't prove this. We're gonna learn about this empirically, but it seems to me that the neutral rate is probably higher than it was during the inter-crisis period, and so rates will be higher.
So the Federal Reserve, without saying you're going to lower interest rates at this point, if you did lower interest rates at some time, I thought you had said you didn't want to lower interest rates and then maybe say, well, maybe we made a mistake and we're going to increase them again. You want to have a policy that's fairly consistent for a while. In other words, lower interest rates, but not bounce back and forth every FOMC meeting. Is that a fair summary?
That wouldn't be a great outcome, but we don't want to be too risk averse. I think we want to, we know that the economy is unpredictable, and the test we've set is we want to have greater confidence that inflation is moving sustainably down to 2%, or alternatively, if we see unexpected weakening in the labor market, or some combination of those two. And when we see that, and the data really show that, and that's reflected in our confidence and our understanding, then it'll be time for us to move. And we won't worry. Of course, it wouldn't be great if you were moving up and down quite a bit. That wouldn't be ideal.
Some of your predecessors used to speak in what I call Fed speak, which is to say incomprehensible to the average person. You try to actually explain things. Is that because you're not an economist, or you just like to explain things better because you actually sort of explain what you're likely to do at the Fed and then you actually explain it afterwards? Does that upset a lot of people at the Fed that you actually try to put it in English?
No, I don't think so. No, as you know, I enjoy communicating with people, and I didn't have a career as an academic economist. I'm not a trained economist, so I don't speak like one. And that I do hear a lot from, for example, people on Capitol Hill that they really appreciate that they can understand what I'm saying.
So today, the ECB lowered their interest rates recently. So why do you think the ECB lowered interest rates before the Federal Reserve? Their economy is weaker than ours, or what?
Yeah, so they're different. There are differences if you look around the world, and the big difference between the United States and many other nations is just that our economy has been so much stronger. Europe went through, the European Union went through significant Eurozone, a significant period of very, very low growth, while we were growing, 3% plus last year. So we're in a different place. And I mean, actually, what's more remarkable about the current situation is how much there is in common between what happened. The global inflation broke out everywhere. Central banks did kind of very similar things. There's little differences in timing in terms of starting to loosen policy, but really the era, I think, will be known much more for its commonalities than it is for its differences like this.
So when the FOMC makes a decision, let's say to increase rates or lower rates, they finish their final meeting, you are authorized then to go out and explain what it is. How long before after the meeting ends before you go out and publicly explain it? Is it 20 minutes or so?
It's 3 or 4 hours usually.
3 or 4 hours?
Yes, because the meeting might end at, I'm out at 2:30 p.m. That's when the press conference starts at 2:30. So I'm usually the meeting's over by 11.
And you don't worry that things will leak out in that interim period of time, I assume?
No, I don't.
Okay.
People know better, I think. And
All right, guys. I think we've seen enough, at least of the main questions. Seems like it's really slowed down here, so I'm gonna hop off for now. If anything updates, we'll drop it in our Telegram channel. If you guys aren't in the Telegram, it is free to join. We'll drop the link in the chat. It is a great way to keep up with our ideas and updates off the live stream. So if you enjoy the live streams, if you enjoy the commentary, we continue the commentary on Telegram. Frank and I, mostly Frank is our readable content guy, so he'll be keeping you updated there on everything that's going on. So make sure, if you have not already, join the free Telegram channel right then and there. You can come join the action. Thank you guys for hanging out with me. That's going to be it for now. But again, stay tuned in the Telegram. We'll keep you updated there. Thank you guys for watching. Have a great rest of your day. We'll see you next time.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.